All right, so I had the futures. Basically, the futures came down a little bit. They're still relatively flat, but the S&P is down a bit. It's showing a tiny bit of fear. So that's what I wanted to know. Are traders bullish about what's going on in the future? Right now, they're bullish still, but they're a little bit cautious. That's why we had that slight drop. In fact, let me go over here so you can see, like, this is where it opened up right here. Everything went up on Friday, closed up here at this 42.81 mark, and then it opened up down here at the 42.76, and it's chilling at the 42.74. So not a huge drop. It's actually pretty small, but it does show you that there is a little bit of fear. There's a gap here. Somebody or some entity wanted to get out of their position because they were afraid of what might be happening on Monday. And that's what I'm wondering. We're having a rally, but is it going to be sustained? That's the important part right here. See, this is what I want to talk about on the stream today. People were wondering, what I was talking about when I said the stream was important. Well, what's important about it is we're looking at what's going to happen with the markets, what the trend is. All right. Most people there's a lot of bearish sentiment in the market right now. People think the thing is going to tank quickly. And I'm not so sure about that. I do think there's more downward pressure because we have rates that have been going up and we haven't seen the effect of that fully go through the market yet. We also have quantitative tightening, which is basically the Fed's balance sheet. They buy bonds and basically lower the supply in the market, so that helps keep prices up. But what they're doing now is they're not buying new ones and they're letting old ones roll off. So they're increasing the supply of bonds. They're basically pushing down, they're putting more weight in the market, and the bond market will affect the stock market. See, the bond market is significantly bigger than the stock market. A lot of people don't understand that. When you look in the media, people are talking about money. They always talk about the stock market, but the stock market is really low on the food chain. If you think about what are the biggest markets, number one, derivatives. So the stuff that's based on other stuff is the easiest way I can explain that. Like if you have a contract based on any asset, that's a derivative. So if the underlying thing is moving around, the derivative is moving at its own pace. And that's the point of a derivative. It's to kind of give you some leverage and some protection from the asset. So that's the biggest market. You think about, there's more money in the derivatives market than exists on the planet. Think about that, right? If you took all the money, the entire money supply of every single country and put it all together, it's still not enough to equal the derivatives market. The derivatives market is massive. It's so big, people don't even know. They're estimating these things. There's one estimate on the high side, which is like 4 quadrillion in that. That's ridiculously higher than everything else. So the derivatives market is king. That one's got the first slot. Then you think about the Forex market, which is currency. So exchanging US dollars for yen or something like that, that's the next biggest market. Then you get down to the bond market, which is a little bit smaller than the FX market. And then you get to the stock market. At the very bottom, you have crypto, but crypto is new, so that's to expect. But the stock market is basically the low one on the totem pole. Everything else has more volume. Everything else has more weight. So when that moves, the stock market has to follow. It's floating in the ocean of those other markets. So you want to pay attention to that. And the fact that the Fed is going to make the entire tide go down with that supply is important to know. So that's why I think there was a little bit of a gap down. We've had this tension release. We had the Fed and we had some pumps because people were betting against it and they were wrong. So they had to cover. A short seller wants to come in and what they do is they borrow shares and they sell them now, hoping to buy them back cheaper at another time to make money on the difference. That's great to do in a bear market. But the problem with that is your risk is infinity. Right? You have to think about risk to the upside is always infinity. Risk to the downside, it can only go to 0, and that's it. Risk to the upside is infinity, which is insane. If you're leveraged, meaning you borrowed money to bet against it and the stock goes up, you have to buy it back at higher and higher prices. And there's no limit to how high it can go. So squeezes happen. And as they're going up, it's getting more and more expensive for the people that bet against it to get out of the market. So they have to buy shares at higher and higher prices. And the thing about that is the higher a stock goes, the thinner the trading volume is going to be because more people are going to say, hey, this is going up. I'm holding it, at least temporarily. Eventually, there's a point where people have made enough money to get out and you hit a wall of sellers. That's what I think is going on with the market right now. So let me switch to the big chart real quick. Let's go to the SPY because it's a little easier to see and it gives you some volume. So let me maximize this here real quick and we can see where all the volume is and what the trend is. So this is what's been going on. This is years right here. So we're going back to 2011 all the way down here. That's about as far as I can go on the weekly. If I move this over, you can see there was the great financial crisis of 2008, which was a very important event, actually. I think people of my generation, millennials, this right here was very formative to us, and it made a lot of us not trust the market, including me, and think everything's a scam. I don't ever want to be in the market. This is all dumb. Everybody lost so much money. But the truth is they didn't lose money. You just had to hold. Look at this volume down here. So many people were freaking out. When this drop was happening, this is one of the biggest, scariest drops in the history of the entire stock market. I mean, the pandemic drop was actually worse than that, but it didn't feel as bad as this because this, number one, lasted longer. And this was systemic risk. The risk on this side was the fact that these banks were lying about what they had and they were going insolvent. And they basically said, hey, everything's fine. And the next day, boom, bankrupt, closed. Sorry, everybody lost their jobs. All your money vanished. Some of it was taken care of because of insurance, but a lot of it was gone. And that's what caused this huge thing. People were freaking out and thought the world was over. But look what happened. It found a base and it continued. And the interesting thing about this, and this is why I have these lines on my chart, this is a standard deviation channel. So what that's telling you is most of the moves that you're going to see will be within this channel. One standard deviation holds like 68-ish% of all the moves you're going to see. Two standard deviations is somewhere around 90, and three is like 98 or 99. So if you got three standard deviations, you're going to encompass pretty much every move you'd see in a stock. And what's interesting about these channels is they hit some of these points and they bounce some of the time. Like look, right before it went into the recession, it bounced off the mean, right? So the mean of the standard deviation is right in the middle. This is where it's saying it should be based on all the training or all the trading and the volume and everything else. The mean is where it hit when right before the great financial crisis. And look at that. 1, 2, 3. Touched it 3 times right on the median and then crashed. But where did it crash down to? The one standard deviation line. Right? It went a little bit below it, but it got rejected quickly. It was right back up within a week. So we got like 1 week down, 1 week back up, and we're sitting above that standard deviation line. So that is why I have these channels on there, because interestingly enough, the world does what the world does, but things tend to line up. That's why I like this, because it's not perfect, but it does give you an idea of where things might be turning around. So I do like to look at it. And that was, I know that was a little interesting history lesson, but the reason I brought this up is because I want to look at what's going on now. So you see what happened in 2008, right? This was a huge panic. This was basically the highest volume panic we've ever had. It's even bigger than the pandemic. The volume in the pandemic didn't come close to this. That's why I was saying this was insane. There's way more trading going on. But the pandemic had a massive drop. If you look at that pandemic drop, look at that. That's even scarier than the 2008 drop. You can see how quickly we fell. This was the fastest drop in history right here. This one in the 2008 and 1929 are like the 3 biggest crashes we've ever had in the history of the stock market. The thing about the pandemic crash, though, is it was super quick. You know, I wasn't ready for it. I was ready for it, but I wasn't ready for it to be as huge as it was. Like in these green candles right here, I was setting up to be short. Like I was actually in the perfect position, didn't realize it. I remember this top day right here thinking like, this is ridiculous. We've had so many green candles. This is way up. I need to get some shorts on. So I did. And the next week, boom, we went way down here. So this is where I ended up actually somewhere up in here. I think it was like the first or second day of the drop. I took my spreads off, which I should have been holding those things. And I didn't make that much money. I was super frustrated because I was like, I'm right. This thing went exactly in the direction I thought it was going to do, more so than anything ever has. And I only made like a few $100 on this. Well, that was because I had a spread in options and I was way too far out in time to catch quick movements like this. Also, I was expecting it to get rejected because every time it did before, if you look at any of these big drops, it's a week or two of down movement because each one of these candles represents 1 week. And then it bounces and it comes up. And the other thing about it is it's bouncing off these averages. So I have the standard deviation channels, but I also have the moving averages. It's a measure of where the price should be based on what the trading has been historically for a set number of days. Right. So this would be 21 days right here. If you an average of 21 days of trading, this is where the stock should be. If you average it 50 days of trading, this is where the stock should be. 100 days of trading, this is where the stock should be. And I don't have the other one for 200, but those are the common moving averages and you'll see them bounce off. Like in 2018, when this high volatility was coming in from the China trade war, it was bouncing off the 50. Like the 50 is a good one to look at. I like the 50, the 100, and the 200 the most. The 20 is just kind of like, that's more of a day trading type thing. And I really don't pay much attention to it, but it is nice to have. But the 50 and the 200 especially, oh, there's the 200. It's just hard to see. I have it in this like dark blue. So yeah, there's the 200 moving average right there. And you can see the higher the number is, the lower the line is because it takes more to move that average. Like 21 days could be moved a lot quicker. That's why you can see this line is very squiggly. But this one down here, if you're taking 200 days, it takes a lot more to actually move it. So when a trend comes in, like you can see the one in 2019 or 2018 right here, where it came down, that line was still going up. Like the market's going down, but the average is going up. So you think, that's weird. But you have to look at 200 days in the past. It's adding all of this, all of this, all of this in with it, not just the days that are dropping. And it's like these are 1 week candles, and you can see it was like a couple weeks down, couple weeks up, couple weeks down, week up, a few weeks down, and then boom. This was when the Fed decided to drop rates, because this whole thing happened because the Fed was tightening too much. And that's what we have to remember. Right now we're in an environment where the interest rates are as high as they were when they were too high right here. Right? This was a very important part. This was when businesses were saying, hey, this is too much. And we're at that point, and we're talking about doubling that possibly by the end of the year. Maybe not quite doubling, but we're going from the mid 2s to maybe 4%. A lot of people are thinking the high 3s to mid 3s. I tend to think that might be a more reasonable spot, like 3.8, 3.9. I think there are a few Fed presidents that actually have that 3.9 number as their target. But we have to see what goes on with the data, because it doesn't matter what we think right now. It matters what the trend is in the economic data over time. So we had the first one, right? So that was one of the things I wanted to get to. So let me bust this open real quick. So we had the first one. We had the CPI. All right, so the previous CPI was, I think, 9.1 year over year. This one is 8.5 year over year, and the estimates were 8.7. It's under the estimates, and it's under the previous number. That is extremely bullish. That is why we're seeing the pump that we're seeing now. You can see this is a really, really big pump, actually. From the lows down at the 3,600 mark, we're all the way back up to 4,200. That's a pretty big jump. That's what, like 600 points? Not bad. And the SPY, it's 1 digit shorter than the actual index, because it's $400 to buy it instead of $4,000 if you were to trade the actual index. But the thing I like about the SPY is it shows the volume, so you can see how many people are trading. And this is what was important. Right? So I was saying they're waiting for the numbers. If the numbers come out good, we could bust through this area of low volume very, very easily. So we got that Fed meeting and everything was in line. The market was happy. Boom, busted right through that low volume environment right here. I was talking about this for months, because it would come down, it would kind of bounce off of it, and we're thinking like, this is nothing. There are very few shares that traded hands in this spot, so this will be easy to get through. That's why you see this long candle back here, long candle, long candle. When you see that, that tells you that there's a level change. And to me, a level change is basically when a stock moves up or down to a point where no matter how much selling or buying comes in, it won't go back to the previous level. It's stuck. It's like a staircase. You take one step up, and that's as high as you get right there. You can't push it down below that unless there's some actual change. There's a catalyst, some kind of news, some reason to make it drop. So it's had level changes and went over this no volume area very easily. And now we're getting into the area where volume is higher. You can see right here where the numbers actually start to show up on my screen. That means that there are way more trades going on in this area. And you can see up here at the 40 mark, there's actually the heaviest amount of volume that we have in this whole trend. The other thing that's really bullish that I want to mention, because people don't always think about this, is we finally broke the trend of 8 straight months of downward movement. Right? Because we peaked right at the end of the year, and then everybody started selling because the uncertainty of what the Fed was going to do was scaring everybody. Then we had that first Fed meeting right here. It wasn't as bad as people thought. Boom, the market squeezed because there were too many shorts betting against it. But what happened? Reality started to set in, because the Fed said, hey, we still have to tamp things down. Money's still going to be expensive. We're going to add supply to the bond market. Things are not as bullish as you think. So the market was dropping. Then we were having earnings, and the earnings were actually coming in okay. See, like some of this was the Fed, but a majority of this, like 80% of this move, was because of earnings. People were coming in just fine with the numbers, but then guiding down for the next earnings season, which is what we're in now. So they were guiding down, and that's scaring the market. The market's thinking, oh, if they're guiding down the next six to 12 months, that means that the stock is going to be worth less, so I have to dump it now. And that's what they did. They dumped everything. But then the Fed came in again, said the same thing. Inflation is bad. We're going to tamp it down harder. Don't worry. And that's what they did. So they did that, got a little bit of a squeeze, but not a lot, because people know that there's still work to be done in the economic sector. And that plowed us way down. But the thing that I was talking about that's bullish is we broke the lower high trend, right? We started here, went down, came up with a lower high. We went down, came up with a lower high. We went down and we came up to a lower high initially. Then when we got the Fed meeting, we broke through it. So this was the last high that we had to get through. Look at that. It lines up with the high volume area right here, which is actually very in line with what you'd expect. And then we had the low volume here, so it burst right through it. We've had a level change. We're up above this high, so this is bullish. People are looking at this like, all right, now how long is this rally gonna last? Not when's the bear market coming, because that has been the mindset. The mindset now is, how long is this rally going to last? Are we going to get to these moving averages? Are we going to get to this high? Or are we going to get to the all-time high? because it is possible. Even though I do think there's more downside in the market, or there's at least a high chance of downside in the market, we still could have a rally that gets to all-time highs, either at it or above it. And there is not much volume up here, which is usually what happens at a high, because very few people want to buy in when the price is ridiculous. And I always feel bad for the person that bought here at 47.9, or it's almost 4,800. So there's somebody that bought at 4,800 thinking this was going up, and boom, they're just trashed this year. So that's why I don't like buying highs. You know, everybody was making money in 2021 but me, because I didn't want to get in. Every day was an all-time high, right? This is an all-time high. This is an all-time high. This is an all-time high. All-time high here. All-time high here. Oh, look, it's going down. All-time highs again. I didn't want to get into that. It was so difficult. I don't like buying because I always fear that I'm going to be this guy right here. I'm going to be the dude that bought Bitcoin at 21K back in 2017, right? They thought, oh, it's going to the moon. And that was the peak. People lost so much money on that buying at the peak. So I just didn't do it. I mean, I should have been buying a little bit. And actually in my long portfolio, I was buying the stocks I like in small quantities, which is what I should be doing. But by the way, this is just my opinion. So make sure if you are doing any of this stuff, you talk to your financial professional and you do your own research. Make sure you make your own trades. Don't ever take any trades from anybody else. Because like I say, every time I've tried to do that and it's never worked. I've made about 10 trades that I got from other people, from gurus online, from videos, whatever it is. None of them worked. Not a single one. And the first few trades I went heavy in, but the later ones I made very small trades because I was wary of just taking advice from people. Even people that seem to be right a lot. When I took their advice, it just never worked. So as a rule, I just don't do it. If I don't come up with the idea or I don't actually like the idea, then I don't touch it. I have to be okay with it. Everything has to line up with my rules. And the rules came from years of getting crushed, right? Having some results, but mostly getting crushed. Those rules are what saved me. A lot of traders give up. 80 to 90% of traders fail and don't make any money. And that was me at first. You know, I got to a point where I wanted to quit, and I did quit at a certain point, but it called me back because I just love this. I love finance so much. It's so weird. I never thought I would be into this, but finance is more interesting than people realize because it's not just about money. It's about human behavior. It's about how we do things. It's about science. It's about technology. There's just so much to learn about how the world actually works when you're in finance. Because if you're investing in a company, you need to learn about what that company does. You need to know the ins and outs of it. So that way, if something happens, you can react to it properly. And doing that gives you knowledge that you can use in the real world. And it gives you a perspective of things you never considered before, which is why I really love it and why it brought me back, because I've learned so much about the world, about myself. It's taught me some discipline. Like, there are so many benefits to being in the market. However, not everybody has that experience, because when you come in, you're raw. You're just a human, right? You're an animal. You have animal instincts that are easily triggered by the market. And, you know, you'll see people that say, oh, everybody knows this and they're preying on you. I'm sure in some way that's happening, but for the most part, it's just the way the market moves. It's just human behavior. People get afraid. People get elated. People have a mania one way or the other. They get ideas in their head and they're sure this is going to happen. And look at any forums. Go on Twitter. Go on Stock Twits. You know, go on any social media page and look at a stock group and see what people are saying. I'm calling this stock to this price guaranteed by this time. They have no idea what they're talking about. They've been watching videos for 2 months and think they're experts. It's that Dunning-Kruger effect. I know because I had it. You know, like when I first got into it, I was really, really into it. And I thought I knew much more than I did, which is why when I made trades and I got crushed, I wanted to quit because I wasn't experienced enough to understand what I was doing. I consider myself an intermediate trader now at best, right? I've been trading for 5 years and I'm an intermediate trader. And I'm obsessed with this. Definitely not an expert. I don't know when I'm going to be an expert or if I'm ever going to be an expert. But at this point, I've hit a stage where I have a strategy. I have some strategies that work. I have a way of surviving. My number of occurrences keeps going up and I'm sticking with it. Even if it doesn't do well or it does do well, I'm sticking with it. You got to remember, if it does do well, don't go too crazy because things can get really bad really quick. And if it doesn't go well, just know that you need to protect yourself and keep going. Just be smart with your money. You know, make sure you know what you're doing. Don't invest more money than you're okay losing, because if everything goes down, you need to be okay. And if you're not okay, then you're investing too much and you need to not do that. So let's get back to the charts. I'm kind of going off on a spiel here. Let me double check and see if we got any comments. All right, no, we're going. Okay, so we've had a nice little bull run, a squeeze because of the Fed, a release of tension. We're waiting to see what's happening. So there are some people that are still in bear mode, I'm sure. But right now, the market is in bull mode. Right? You don't want to fight the current. Even if you know things are going to go a different direction, don't try to get in and try to force everything early because you don't know how long these rallies are going to last. We could get a bunch of positive news right after this and things could pump. There are certain things weighing on the market that, if relieved, will cause a bull run. And we've seen a little bit of that right now. If more stuff happened during this release of tension, we could have had a shot way up to the all-time highs easily. In fact, we're almost halfway there. If you look at that, the distance between here and here is like, or between here at the top and here at the bottom, the middle is somewhere in here. So we're kind of in that area. And look at, that's where the high volume is. So that's kind of to be expected. So as this goes up more, there's more and more weight pushing down. That's why I say, how long is this rally going to last? Because it's going right now. It's very, very green. We have big candles. We're cutting through a lot of the resistance. But as we go up, the resistance gets harder and harder. I mean, right here, the density is the highest. So are we going to be able to pass this? That's what I'm wondering. So we're in bull mode now, right? You have to think about that. Like, keep the mindset of bull mode again. We've been in bear mode for the whole time. During this pump, we were still in bear mode. During this pump, we were still in bear mode. Over here, when it's consolidating, still in bear mode. But because of what the Fed has done, we are now in a temporary bull mode. So how long is that going to last? Don't get caught up trying to bet on the downside just yet. And I mean, unless you're really good, you know what you're doing, that's fine. But the way I see it, this is not quite ready. If we start hitting tops and it just won't pass a certain point day after day after day, if it's tested an area around here 2 or 3 times and it gets rejected, then we'll know that that's because things were too heavy right there, and that bull run might be over. But if it cuts through all this stuff, we don't have a lot of resistance up here, so it could run again. This is the point to beat right here. We've got the highest volume candle right around this 4,400 mark. We've got multiple moving averages hitting right around here. It hasn't quite got to it yet. These are weekly moving averages, so these hold a little bit more weight than the daily moving averages. Same with the candles. I used to look at everything in daily, hourly, minute timelines, but now I try to do it in weeks and days because it's so much easier to see a long-term trend and bet on that than to try and catch the day trading action for me. Other people, they can do it. Me, no, I can't. I need to be able to see this over the long term and have some kind of confirmation that the trade I'm making is correct. So this is what I was expecting to happen. It's a little bit more intense than I thought it was going to be, but this is what I was expecting after the Fed, because I thought, number one, they were going to come in line, which they did, and number two, I thought there was going to be a release of tension from a squeeze that lasted for a couple of weeks, and it has. So that's what's going on, but it's higher than I expected. So that's why I'm saying bull mode confirmed, because we got so much upward pressure. However, during the week, it was looking very toppy. So this could be the top. Let me switch this from a weekly to a daily timeline here. And you can see when I zoom in on this, it's hit this point a few times. We ended on a high, which is good, but it was kind of sitting there for a little while before it actually was able to move. So yeah, you can see that we hit this top a bunch of times and then we kind of broke through it. We ended Friday on a high. There was a nice squeeze at the end of the day. It was pretty low, but for the rest of it, but you can see right here, these 3 days, even though it looks like an upward trend and it is an upward trend, it was very volatile and it wasn't going directly that way. Like this red candle means it came back down. So it went up to this point, got to the next day, tried to go up higher, but got slammed right down to this point. However, Friday, it opened here and took off. So what are we going to do next? That's the question. So we looked at the numbers, right? CPI came in at 8.5, which is lower than the 9.1, and that was the data point I was saying was important. The CPI and the PCE are two of the most important pieces of economic data you can pay attention to while you're trading, because those are the big things that the Fed are looking at. They're looking at other stuff too. Yes, it's the Fed. They have all this complicated stuff, things that I don't know anything about, way more advanced than I'll ever be. But when it gets right down to it, they're looking at how expensive are things for people. Can people afford food? Can people afford their rent? That's what they're looking at. Now, some of these numbers exclude rent. Like I think the PCE actually does exclude rent because it gives you a more accurate reading of the rest of the market. But at the same time, taking out rent also brings the price down. So it's a way for politicians to look a little bit better and say, oh no, inflation's only at this percentage. Well, yeah, because you're not including rent. The PCI does include rent, but the PCE doesn't, from what, if I remember correctly. I could be wrong on that, but I think that's the way it is, because rent is massively volatile. Just like food, energy, and rent are all extremely volatile. So trying to factor for all those can be difficult. And that's why there are two numbers. There's the headline number that comes out, and then there's the core. The headline includes food and energy. The core does not. So PCI was one of the numbers they were looking at. That was very important. It came out under, that's why we had a squeeze. Important to know. So the next thing we had was the PPI, which is the producer price index. It's the same thing as the consumer price index, but instead of focusing on everyday consumers buying goods and services, they're talking about the businesses themselves. How expensive is it to get the things you need to make your stuff go? That's what the PPI is looking at. So that one was also under a little bit. Core was 0.2. The estimates were 0.4. Prior was 0.4. So PPI is down, CPI is down, and consumer sentiment is up a little bit. The Michigan Consumer Sentiment Index is 55.1. The estimates were 52.5. So people are slightly more bullish on the market than the consensus was expecting, and more bullish than it was the last number too. So we had a 50, and then we had a 51. Now we have a 55. So people are getting a little bit more bullish as time goes on. Those are important data points. Remember that. The market reacted positively to these numbers because they were a good sign that possibly inflation is peaking. That's what they're trying to see. All right, how expensive is everything? Are prices coming down enough to be manageable? That's what they're trying to do. They're trying to get price stability. So we had those numbers. We also had unemployment, which is below estimates. Estimates were expecting it to stay at 3.6, which is where it's been for the past couple of reports, but it is now down to 3.5. So that's the other reason why I say there's not as much gloom in the market as people want to say, right? Employment is high. Unemployment is under the estimate. So more people have jobs than the consensus expected, right? Now, and also the non-farm payrolls came in at double what they were last time, which means we added a huge amount of jobs. Non-farm payroll came in at 520K. The estimates were 250, and the previous was 372. So it's way, way above the estimates. It's double the estimates. It's like 250 for the estimates, 520 for the actual number. So that there are a lot of people that are getting jobs. Unemployment is down. Non-farm payrolls are up. And let's see, wages are up 5.2% year over year. And they're up 0.5% from June. That's good for workers, but that also can be negative for inflation. The higher wages go, the more money people have to shove into the markets. It's not my favorite number to look at because it's depressing, right? The higher that number is in a situation like this, the worse our situation is. But the problem with that is the higher that number is, the better people are doing at the moment. You know, so it's like, are you betting against people? Are you betting against the success of everybody, the country, the world, so that everything will be okay? No, I don't want to do that. But if the number continues to go up, that's going to keep inflation going, because wages aren't everything. There's a whole political argument about wages, but they're a piece of the puzzle. And if you're thinking about, like, where does the money come from? Well, it comes from how people make the money. If you get a job or you do something yourself, you're going to earn money. That's going to allow you to buy things you wouldn't have bought without it. So it's going to be able to increase inflation. If you have a good amount of money and you want a scarce product, you'll pay more than somebody who can't pay as much. And that's how inflation continues to go up, is people will just pay more for things. People with the money will pay more for things when times are scarce, and everybody else gets squeezed out. So we've seen that jobs are up, wages are up, non-farm payrolls are up, CPI, PPI down, consumer sentiment up. These are all bullish numbers. This all tells me that this bull run that we're having right now is probably going to be sustained. We've come down quite a bit, but I mean, look at how much we've rebounded. If we go with a long-term chart, you think about, here's the pandemic drop. We had the nice bull run until the end of last year. Here's the drop. We've recovered almost half of that. So that's extremely bullish right there. This might be running into some more resistance right here, but if it goes beyond it, we've got a chance to go. So we've got all these bullish numbers. The shorts are getting squeezed. Other shorts are coming back in because they're expecting a drop. So the squeeze is going to continue for a while. So that's the thing about short squeezes. They don't just finish right away. Most of it will happen right away within the first day or week or whatever it is, but there are going to be people that, number one, held on longer because they had the money to be able to do that, and two, new shorts coming in because they're thinking, here's the top. Good thing I didn't get in before. So they're going to make the cycle worse if there are too many of them. And I think that's part of why everything pumped as high as it did, is we had so much negativity. If you look at the media, all it is negativity. Negative, negative, negative. Everyone's going to die. We're all dead. But we're not. Look at that. We recovered half of it. Within a couple of weeks, boom, back up halfway to where we were. Hugely bullish. I mean, that's what these rallies do. People think it's going to be like when the pandemic happened, people think it's going to continue to be bad. So they were betting against it, betting against it, betting against it. And when they finally start to get into the market, then it crashes on them. You know, that's how it goes. That's human nature. It's why I say you need discipline, and trading will give you that if you stick with it long enough. So the numbers, all of them came in good. We had a few more numbers, but I don't care about those. They're all good, right? They're all bullish. We don't need to worry about that anymore. So the Fed funds futures are pricing in a 38% chance of a 75 basis point hike in September, and it was pricing in a 68% chance before the CPI. So this rally is partially because of that, and that shows you the next meeting. Right now, 50 basis points, a lower hike is in, which is good at this point. But we'll see what actually happens as we get closer to the next Fed meeting, which I believe is in mid to late September. So we still have a little bit of time. We're going to have one more set of economic data numbers coming out before then, and they're going to give us, or maybe they'll come out right after. I don't know, but I was thinking they would come out beforehand. They're going to be out somewhere around that meeting. That will give us a better idea of what's going on. See, my fear is that people get to see this number from last month and think, all right, it's better, and they start spending again. They start putting money right back into the market and not thinking about it because they think it's over, which could cause inflation to continue, which would cause the Fed to tighten even more. That's what the Fed's going to do. They're just going to tighten, and then they're going to watch. And if things don't come down, they're going to tighten more. And they're just going to keep doing it until the environment is so dense that people aren't able to cut through it, and they have to stop spending as much as they are. So the Fed funds futures are pricing in a likely 50 basis point hike at this point. So if everything stays the same and we get a 50 basis point hike, the market will be happy about that. Let's see. The Fed's balance sheet is going to be twice as big as its peak was in 2014. So that's the other thing we have to remember. The Fed holds more assets on its balance sheet than it ever has. That's what it took to get this market out of a recession. The Fed had to buy up so much stuff that it's eclipsing previous highs. Which makes sense because the last time we did it, the same thing happened. It eclipsed previous highs. We dumped a bunch of money into the markets. Everything's the same. It's always the same thing. People think it's not going to last. You can't do this forever. Well, you can do it for a lot longer than people think, which is why the market continues to go and why it's always been a bad idea to bet against it, including this time. Now, even if this continues to go down, which I think it will because this much green is unhealthy, so there's got to be at least some consolidation from that. There's got to be a return move to some place. I'm guessing somewhere around this 4,100 area for a little while because that's the high congestion area, maybe all the way back down here. But depending upon what happens with the market, we could either get a nice little trickle down or a nice little trickle up. Sideways is possible too, but I think with how much volatility we're having, we're going to get a slight trend one way or the other. And I'm not getting too into any of them because I don't know which way it's going to go at this point. We're waiting for the next Fed meeting now. We're waiting for data. We're waiting to finish earnings season and then the next Fed meeting. That's what our current plan is. We have to see what's going on. So the past two Fed meetings have been great. I made trades that were very profitable on both of them. It's been exactly what we were expecting each time, so that's been nice. But we don't know what's going to happen in the future. So I'm trying to plan for that. I'm trying to get ready to do anything. I mean, depending on which way it goes, I want to be able to make money on it. And that's the whole point. I want to make money whether it's going up, down, or sideways. And that is possible. So that actually will bring me to what I've been doing. So let me check chat real quick, see how we're doing with that. All right, we got a few things. Hey, Ash and Phoenix, Raiden, what's up? How's it going? Thank you for the raid. I appreciated that. Also, Life of Ronan, you raided too. Thank you for that. I appreciate the raids. It's nice to have some support here. By the way, if you're into programming or gaming, check out Ash and Phoenix. He has a really good stream. SNP, Saturday Night Programming. I'm ready for it every week. So I wanted to get into some of my trades here. What I've been doing is I've been doing a mixture of things because we're in an interesting market. We have the bull thesis now. We have to be in bull mode. So get ready to, if you're selling calls, there's some risk in that. You might get blown out on those. You have to go way out in time if you're going to be doing that. But, buying puts, maybe. If you're looking for leaps, that might be a way to go too. But I'm mostly looking for pops on things, right? We still have earnings season going. So any company that hasn't reported yet has a chance to pop, because they guided down last time. And that was the important thing. That's what I was saying when last earnings season was going on and the market was tanking. I was saying everything guiding down is good because it means either next earnings season or the earnings season after that, they have a chance to pump big. Some companies really did too. That's because guidance is what drives it. The company will report their earnings. You'll see whether or not they're somewhat in line with what people thought they were going to be. And then they tell you what they're going to do in the future. And that's what the stock reacts to. The next morning, analysts will have been listening to that call. They'll be making judgments and they'll put out a number, a new price target, an evaluation of the stock that's either favorable or not. And that will pump the market even more. So good guidance, good analyst upgrades, that'll move things quite a bit. And that's basically what we've been having. We've had so many stocks reporting better than people thought, and analysts saying, hey, here we go. So let me get to the first one. This was probably my best trade of the week, AMD. I had an iron condor on it. I expected that it was going to stay within the range that it's in now. So let me go ahead and maximize this cell right here so we can see. So this is a daily chart. When it reported right here, it pumped. Right. And a couple of days later, it had to squeeze because it had this nice jump. So the shorts were going, it's not going to be as good as people thought. The whole Taiwan thing is probably going to put pressure on them. But no, they have the CHIPS Act. right? There's subsidies are coming to these semiconductor companies. So there's positivity in their future, which is why I expected them to guide up. I actually had shares. I let them go somewhere in here. I want to buy them back again. I know every time I do that with AMD, I buy it at a good price and I think, all right, cool. Here's my AMD shares. I'm going to keep them. But then they pump. They pump quite a bit. And I'm like, I'm up so much that I don't like to just hold this, man. Like at a certain point when you're up, you got to take your gains because if you lose them, you're going to be pissed. That happens a lot. So, I was buying it at like 70. Where were we? 70 something? In here, in this little mess right here, I was buying AMD stock because I expected them to do better than people were thinking. It's AMD. They're really solid most of the time. And you could think that, the pandemic boom has dropped. During the pandemic, people were working from home. There was a lot of demand for PCs. So they were making money hand over fist during that time. Also, there was the crypto bull market, right? All these chip manufacturers were making money from that too because people needed to buy mining rigs. They needed to buy video cards that were capable of mining. They needed to buy all this hardware in order to do it. If you think about big mining rigs, that's like server farms in giant warehouses with thousands of computers. These companies were doing pretty well because of that. So Intel reported that it wasn't, right? Intel reported that its business was difficult right now because of the fact that PC demand has dropped. So everyone went, AMD, they're reporting next. They're not going to do as well. Well, I thought, you know what, AMD is super low. If they get hit on earnings even more, I'm going to buy more. I would I was buying it in the 70s. I thought if it went down to the 60s or 50s or 40s, that would be wonderful. It'd be a dream come true for me. I'm not trying to get it, really high because who knows where it could go. Even though it went high, really, really high last time, I still just don't like buying on tops. I don't like buying on big green pumps. I'll add a little bit if I have the stock, but I made my money on it, so I dumped out. However, after the earnings report, it had its little squeeze. It did better than it thought, but it still did have weak demand in the PC department. It was having trouble selling a lot of these chips because of the fact that people aren't ordering as many PCs. Now, certain things like phones and all that, the chips they make for those kind of devices, those were still up because those continuously go. But PCs themselves, if you think about it, you build a new PC, you're good for a couple of years for most people. Yes, there are the people that always have to have the new thing and get a new video card so that when they run an analysis on it, they can see the number go up by 2 points. Oh, it's so much fun. But there are the people that just get the computer and go. And that's what's been happening. During the pandemic, a bunch of people ordered computers. They set them up and they're still using them. See, I got a computer right before the pandemic. Prices were high then, but they went up even higher, so I was kind of glad that I did at that point. However, AMD reported well. They did have some problems. They squeezed, and I thought, all right, this is an opportunity. So during this volatility, I put an iron condor on. Actually, I put an iron condor. I was ballsy. I did it right before the earnings season. And I put an iron condor in like 109, which is right up here, right? So my thought was, this peak right here. I sold this contract, and then I bought protection above it. And 89, which was down, where is it? Right about here. So 89 was where I thought, like, all right, between here and here is a pretty good range. If you look at where I'm moving my mouse right now, if you're watching the screen, you can see this is a nice range. Anywhere in this range, I would end up being profitable on that iron condor. And I expected, because it had already climbed so much, it had a top right here. If we back out a little bit, we can see that it has some support and resistance at this point. Look at 102, right? It would come down to 102, bounce, bounce, bounce multiple times. And once it went through it, it would test, 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 and get rejected. So this is a strong point. I thought this is a point where a lot of shares are changing hands. So I'm confident in throwing an iron condor above that with a small spread. I didn't go too heavy on this thing because if it did go to the upside, which it could surprise to the upside and blow through everything. AMD does do that sometimes because it is a good company, but I didn't expect that to happen now because there's still the pressure on with the market. There's going to be the bull run. There's going to be the shorts that get squeezed, but once that tension is released, where does it settle? And this is where it's kind of settling, right around 100 basically. So that's what I was hoping. When it pumped up like that right after, I took off the bottom leg of my iron condor. So down here at 89, when it was pumping up to like 104, 105, these 89 contracts were basically worthless. So I took them off. Boom. Not 100% profit, but pretty close. Let's say like 80 or 90% profit on this bottom leg. Then after that, it came down for a few days. And when it was down in this lower area, I thought, all right, I'm going to take my upper contracts off because they're next to worthless too. I think there were like $9 left on them. And I thought, well, it would be nice to get those, all those contracts down to the $9, but I don't want to take that risk because it's like you're risking basically complete failure for $9 a contract. And if you don't, depending upon how many contracts you have, that might not be that much. So I decided to just take it off. It would have been nice. I could have waited because it was still staying in that area. I should have waited until Friday. But because I had this opportunity with it going down, I just took it off right then. I would say between the two legs of the spread, I got 70 to 80% profit total. That's not bad. Normally, I'm shooting for like 40% when I sell options. And I don't do iron condors very often because I usually think the stock's going to move in one direction or another. So I don't want to be exposed to the direction I think it's going to move. But with this one and how much it had moved before, I thought this actually looks like a good iron condor candidate. And man, was I right. It was perfect. Everything went the exact way I want to. It goes up towards one leg, you take off the profitable leg. It comes back down, you take off the dangerous leg. And that's what I did. So that was a nice little trade right there. Iron Condor, 89 to 109. Had this whole range, didn't even need it. I only used about half of it. I could have been way closer and made a lot more money, but I just didn't want to take that much risk. I actually found a nice spot right here. If you can get about a third of the width of the strikes as credit, then you're a lot safer than if you get anything else. And what I mean by that is when you make a spread, you're selling one contract and you're buying another. So you're basically saying, I don't think it's going to pass this point. However, if it does, I want to have protection. So that's why you buy a spread. You could buy it naked. You could just sell a contract below and above it, but you have to have a lot of money to do that because, like I said before, risk to the upside is infinity and risk to the downside could be heavy as well. So having a spread protects you a little bit. So I was able to find a third of the width of the strikes, so 30% of how much I'm risking basically on each side. Far away. Like a lot of times you have to get these iron condors like right up here next to it. You're not going to get enough cash. Like I want some space, and this is a good amount of space right here. So having $20 of space, 89 to 109, that's a nice little spread right there. I don't get those that often, which is why I don't do a lot of iron condors because some people are they like to get right up on it. I don't. I want to make sure I'm far enough away to protect everything. Sorry about that. I didn't see you asking what's an iron condor. An iron condor is where you don't think a stock is going to move that much. You're selling a spread above and below it with the point of it staying where it is. Because when you sell options, what you want is you want that contract to decrease in value. You're basically taking a premium in order to take on the risk. Someone else is paying you money in order to take on risk for them. But the thing is, most contracts expire worthless. So if you're the seller, if you're the one taking the risk, you have higher odds of winning. Because look at this stock. I mean, you think about how much this moves, it doesn't continue to go in any direction for very long. It'll move way up for a while, then it goes down for a while, up for a while, down for a while. So you can see that an iron condor would actually be good sometimes, since options have a time limit. And you can make a lot of money if you buy out of the money options and hold them until the stock moves into the money, but there's a lot of risk in that. So selling options is lower risk. However, you have to take on the risk. If you get annihilated, it's going to hurt. You're always going to take on more risk than you can get reward. That's the downside for being a seller. You're never going to get 100% of the risk, or at least close to that. I mean, you're lucky if you can get 50% of what you're risking. So in this case, let's just say you're risking like $500 on each side, right? You have to get a third of that $500 to be protected enough to feel comfortable. Because if the thing comes up and gets close to your contract, that contract is going to increase in value and you would have to buy it back at a higher price, thus losing money. So the thing that I like about an iron condor is when you have a company that you think isn't going to move, you can put an iron condor on, hold it for just a little while, let the value drip out of those contracts because there's something called theta, which is basically how much money you're losing on your contract every day that it's not in the money. If a contract, like if a stock's at $100 and you have a $110 call, every day you're losing a little bit of money to hold that call. And the person that sold the contract is gaining that money. So you're getting a little trickle of money every day, and you're also getting a trickle of money if the stock moves away from that contract. So if the stock's at $100 and you sell the 110, if the stock drops to 95, the profit you make from that contract is going to go up. You're going to make money as that contract shrinks. So an iron condor is a great solution for a stock that's not going to move. There are many different strategies you can use when you're using options, but I like using an iron condor because both wings of the iron condor have the same amount of risk. So if you have $500 risk on one side and $500 risk on the other side, your total amount of risk is only $500 because that stock can only breach one of your wings. It can't hit everything. So your risk stays the same. So you basically get to put on two trades for the risk of one. Because normally if you had two different, let's say you sold the 110 call, right? And you also sold the 105 call. Well, now you have two contracts risk to the upside. If the stock moves up that way, you're going to have double the pain. And actually even more than that, because if you're closer, if the strike's at 105, it's going to be more expensive. The closer contracts are to the money, the more expensive they get. So if you sell a contract way out here that's completely worthless, and you're holding the risk, you think, the stock's never going to move up here. I'll just take this piddly amount of money and hold the risk for a little while. But if the stock moves up that high, you're going to be in a world of hurt because you didn't make that much money to hold that risk. However, if you're in a good spot, if you've got about a third or more of the width of the strike, you can stand to have a little bit of a move against you. It happens sometimes, and that's okay. But the stock also doesn't continue in one direction for too long. So it's a good thing to wait out these moves if you're confident in your trade. Number one, it'll give you time, it'll give your contracts time to decrease in value, which you want as a seller. And number two, it'll give you time to be right. A lot of people want to make money in a day. It doesn't always happen like that. If you've got a thesis about something, follow through with it and just wait. Just hold on. Don't put any more in than you are okay losing. But also don't give up right away, because a lot of times people lose money because they gave up. They shorted it and it went down. Oh, it's close to my contracts, I need to sell. But look at what happened after that. It bounced. If you had just held a little bit longer, then you would have been fine. So that was a good trade on AMD. That Iron Condi was one of my best. I was very happy about that. So there's that trade. Let me pull up my notes and see what else I have going on here. We had that. Oh, I also wanted to talk about 23andMe. So I've talked about this for a couple of weeks now. Somebody came on the stream and asked me about it. And at the time, I had looked into it a little bit, but I didn't know that much. So I said, all right, I'll get back to you and do some research. Well, I did some research, and I actually really liked the stock. So this was coming in at about $2 and something cents when I was first told about it. So let me go back to ME real quick. So you can see the stock IPO'd last year. It's not a very old stock. It's extremely new. You don't have enough history to really trade it very well. But when it was hanging out here in the low to high twos, somebody brought it up to me, and I had looked at it before and just kind of dismissed it. But once I looked into it, I thought, man, this is actually a really nice looking company. It has prospects. Yes, it's a penny stock because it's in the $2 range. So a lot of people are ignoring it. And people will also think, oh, a $2 stock means they have a lot of problems, which they do. They have problems. It's not all perfect. But I thought, all right, they have a bunch of cash. They raised a bunch of cash already. They just bought Lemonade, so they're in the telehealth business. They have a contract with GlaxoSmithKline to develop DNA-based drugs. And they're in a space that's still growing, right? They're a legitimate company. You know about them. You can use their services pretty easily. They're not just some mystery penny stock that's in some random tiny building in a town in the Midwest that nobody ever goes to, because it's basically just a stock and it's not really a company. This is a real company that's extremely low priced for what it actually has. So when something came up, it was going to be pretty big. And look at this. It went from 2 all the way up to 5. So I bought some leaps all in here. I mean, the leaps I was buying were like the 10 strike. They were about $30 a pop right now, or at the time. So I was buying these 2024s, so long time contracts, for $30 a pop. And basically, if this thing gets up to $10, those contracts are in the money. And if you look at historically, even though there's not a lot of data, you can see that $10 is not unreasonable. When it first IPO'd, let's see, where did it IPO? Right here at about 11.15. So they were trying to go about $11, maybe $10, but it IPO'd a little higher than that, pumped up to 13, and then it spent a bunch of time coming down. Pumped up again to 13, and it's been dropping ever since. So I was looking at that. A company with cash, a company with new prospects, a company that's growing, a company with contracts with other successful companies. There's just so much that's bullish about 23andMe. Now, a lot of people, I dismissed it. A lot of people were dismissing it in the chat. People I talked to were kind of dismissing it. So I understand. It didn't look very good. And it still is going to have problems. I don't think this rally is very healthy. I don't think it's going to last. It's moved up over a standard deviation within the matter of a few days, right? Or a couple of weeks, let's just say. However, it's been a nice pump. So those contracts I bought that were $30, last time I checked, were between 90 and 120. So they've tripled or quadrupled in this short amount of time. I was hoping to buy more contracts. I was trying to buy them slowly over time, but everything kind of came to a head a little quicker than I was ready for. I still have a few contracts, actually. Multiple accounts have contracts in 23andMe, but I don't know how long this is going to last. As long as the market continues to go up, this will probably follow it, because it's a better stock than it looks like it is. This $2 range is too low for 23andMe based on the fundamentals. So I can see it coming up. It could still go back down there. It doesn't matter what the fundamentals actually are if the market is freaking out, because emotion always rules, right? Fundamentals rule in the long term, but emotion rules in the short term. And that's what you have to think about when you're trading. In the future, things could be whatever. You might have a good vision of the future. It might be easy to see something. Yes. However, in the present, people are going to be extremely emotional about it, and they're going to trade based on that emotion, which will move the market in ways you're not expecting. Because not everybody does the same amount of research as you do or I do. A lot of people just kind of invest in things because, they work, they have a 401k, their job puts a little money into that, and that 401k buys into some generic S&P index fund, which I think is a great way to go. I mean, if you just want to follow the gains of the market, just get a basic index fund. You don't have to worry about the headaches of trying to look into every stock and make trades like, oh no, I bought this company and it went down. I wasn't expecting it. You get an index fund. You don't have to worry about any of that. It's good, especially when things are down. That's a great time to pick up more in an index fund because as things go up, it's going to be so much more valuable. So these kind of things, these pumps right here, they're not fully sustainable when you see constant green candles like this. See, that's the one thing, like I like a pump. I like a good bull market run, especially during a bear market because it catches people off guard and it's a chance to reposition and take some gains. But it's not sustainable when you see 1, 2, 3, 4, 5, 6, 7, 8, 9 straight green candles that have a nice trajectory. It's up almost double from where it was. It was in the low to high 2s, and now it's in the low 5s. So we're close to double. And the contracts that I have are leveraged, so they're like triple, quadruple. And I'm thinking, should I take profits on that? I actually took one contract off the table on Wednesday or Thursday, right? Because when it started getting up into this point, when it was close to 4, I was like, oh man, I was buying this in the 2s and it's at 4. It's almost doubled. I should probably take some of my gains. Well, it continued to go up after that, so I wish I hadn't sold that one contract. However, if everything crashes, then I'll be okay because at least I took some gains. Because that's the thing, you're never going to get the top perfectly. You're always going to beat yourself up for missing some little opportunity, but you have no idea. I mean, emotions affect you too. The moment affects you too. You're going to be swayed no matter how smart you are, no matter how prepared you are, how disciplined you are. You're going to get hit by the emotion of the market. It's just part of it. So taking some gains and getting little things in while you can may not have made you the most money, still at least got you something. So be happy you got some gains. If you have picked up some gains, be happy about that. So even though I really wish I'd held that contract, I'm happy that I took some gains. 3x to contract in a matter of days. Well, I should say a matter of weeks, actually. Not bad. I bought those contracts and then I kind of ignored them. I thought, whatever, they're so cheap. If it goes down a little more, I don't care. $30 a contract. I mean, that thing could drop to 20, 15. I don't care. I'm still good. I'll add more as it drops. But now that it's pumping, I don't really want to add more because I know where the top is. So I'm looking at unloading them as this thing continues. But I'm kind of wondering if this bull market's going to go more. Some people think it's going to drop. I kind of think it's not done yet. It really has to exhaust itself. It has to get to a point where it just keeps hitting resistance and won't go through it day after day, week after week. Or we have to get some new bad news. Right now, we don't really have a catalyst that could move things down really hard without something like the Fed coming out. Some pressure on the market ending right away, which I don't think it will. So right now, the environment is up until further notice. So let me go back to my notes here. Rite Aid. So here is a trade that didn't go as well for me. This one's been fun. So Rite Aid's been one of my good trades. It's been a very steady short for quite a while. If you look at this chart, I mean, this is down, 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 down. Everything's down. Any peak you get is a great opportunity to short. And it took me a while to get in on this, because I don't like to short that often, but because it was so reliable, it's just, look at, this is 2 years of data almost right here. Down, 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 down. Nothing but down. However, recently it's been pumping. So I started adding some shorts. I think I added some shorts in here, and I didn't take my gains when it dropped because I expected this to be the top of it. However, it's still going up. And there's not a lot of news on it. And all the insiders that were buying bought in the previous cycle, so I'm not seeing why it's pumping any more than the fact that it has a high short interest. I think right now the short interest on this thing is like 20%. Is that what it is? Yeah, 20%. So the short interest on Rite Aid right now is 20%, which is a good recipe for a squeeze, which it seems to be getting right now. And the market, if the market continues to go up, I think Rite Aid's going to follow it. Regardless of its actual finances, it's mostly going to move with the market, and it's a mention on Wall Street Bets because it has a high short interest, which is what they're looking for. They just want companies with high short interests so they can get everybody in buying them and hold the shorts in there until they can't stay and they have to buy to cover, which pumps the stock. So this one kind of crushed me. I had some profits right here, didn't take them, and now I'm not fully underwater. I'm more towards break even on one, and I think I'm underwater on another, but I added some on Friday because this huge pump right here was an opportunity. I don't know if I'm going to be right. It might continue to go, and I might continue to get squeezed, which is why I'm not going too heavily in it. But if this thing ends up topping right here, if I see multiple days where it's not going any higher, I'm going to lean into that short a little more, because at some point the market's going to come to its realization that that fundamentals matter. Right now, it's the party. Everybody's happy. The tension's relieved. The future's fine. Everybody in the future, our future selves are going to have to deal with whatever's happening. That's the mindset of the market right now. But at some point, people are going to go, oh, things are happening right here, right now, and we might have to make adjustments based on what's going on in the market. So once that happens, then I think that this Rite Aid drop is going to continue unless they sell. So that's my enemy right there. If somebody buys the company for a good price, that'll knock my shorts out completely. They'll be done. Everything will be dead in the water instantaneously. So that's my only fear. So I'm not really going heavily just in case that happens, because this pump, somewhere around here, there was a pump, this one back here, where a company offered to buy them for like $800 million. It pumped on the day and then continued to drop. This is a wonderful short. I caught it somewhere on the way back down, like right here, and then I took it off somewhere in this mess right here. So it was a nice short. But we're in a different environment now. We're in a bull market. We're not in a bear market. It may be temporary, but we are in a bull market. So the mindset is different. I don't want to short too heavily because this thing can continue. If things flip around, I want to be able to hit this thing hard. So this one I'm watching, I'm in it, I'm adding a little bit, but I don't think it's going to go very well for me. This is probably what I'm going to be talking about as a cautionary tale in the future. So that was the other stock I want to talk about. Oh, here we go. Bed Bath & Beyond. So that was another trade that went well for me. I ended up shorting this one too, because it's the same thing. It's just down, down, down for the most part. It did have some pumps a couple of years ago, but other than that, it's mostly down because it is a struggling business. It's not dead yet. It's going to be there for a while, but it has a lot of headwinds it needs to overcome. And if you look at this price action right here, when this happened, this pump way up here to $13, I was shorting somewhere at the top. And I ended up taking my gains 2 days later, I think, 2 or 3 days later. So somewhere in this red mess, when it wasn't going down any farther and it was kind of, basing somewhere around VWAP, I thought, okay, this might be a good time to get out because it could pump. And look what happened. It pumped, which is what you should do with shorts. Like if you short something, especially if you short something that's decent enough company, there's going to be a rebound at some point. So you really have to be careful with your gains and take them when you can. There are certain penny stocks you could short and ride those things into the ground. I don't really know how to do that because I'm not as good as picking those things. They all look like scams to me, except for something like 23andMe. Like that's an obvious one. But other than that, I can't tell which ones are the definite shorts and which ones are the somewhat shorts. So I just leave those alone. But when you see something like this, extremely high short interest, it's been pumping for a few days. It had a nice gap up on that day, which I believe was Monday. Yeah, Friday, Thursday, Wednesday, Tuesday, Monday. So it gapped up on Monday, but it got rejected at the really high prices. And that was what lured me to the short. Like it came up here pretty quickly, but it was getting rejected quickly as well. So I got in that short, watched it go down, saw it kind of sitting where it was for a while and decided, all right, it's time to get out of this thing. And that was a great time to do it because boom, right there. So I made some money on that. That was nice. I'm watching Bed Bath & Beyond, but with everything going on, I don't know if I want to get heavy into it right now. If this thing pumped really, really high, like back into the 20s, and there was no news for that to happen, or there was no news causing it, then I would short the hell out of it. But because right now we're having a pump, we're having all these different things, I'm just going to watch it. So I made my money, not a lot, but it was something. And so I'm stepping out. All right, so the next stock I want to talk about, as I accidentally kick my laptop and almost knock it over, is, let's see, Wendy's. So Wendy's is one I talked about a while ago. Wendy's has a very stable price level. It, if you look at it over the past few years, stays in that 19 to 24 range. If it's up above 24 like it was this one day, you got to short that because that's an obvious one for this stock. The news didn't even make it go that high either. This was like earnings or something, I think, or it was a little bit after earnings. Now, when it was down here a couple of months ago, I remember talking about it on my stream going like, this is an opportunity. This company is very heavy, even though people think, oh, it's not going to do well. It doesn't go up past a certain point. That's okay because it's a good enough company that it's not going to go down that much either. It's going to hold its spot really well. And look what happened. It did. So when it was down in this area right here, I remember it was all red. It hadn't bounced at all yet. I looked at it and thought, man, this is great. Yes, I remember this. So somewhere in here, I think it was this part, I had some upward contracts. And yeah, because it was after earnings seasons, it had pumped. It dropped a little bit. It's somewhere mid-May. I thought, all right, this is a good time to get contracts. And I think I got them like right here. I remember it was a couple of days before this happened. And then there was the pump. Boom. Came up to here. I took those contracts off right away. I could have held them, But because I was so profitable so quickly, I decided, nope, I don't want to ride this. And I was actually right, because it stayed in that price level for a while and then dropped. So I took my gains during this pump right here, which was a great time. Bought it here, sold it here. That doesn't always happen. So I was very happy about that. But you can see with Wendy's, it trended all the way back up. If you look at what most stocks have been doing for this year, they've all been trending down with some bumps. But look at that. Ever since May, Wendy's has been trending up. It's going back to its comfortable level. It's fair value. This is where people think it belongs, somewhere around 20, 21 bucks. If it's down at 18 or dipping below 18, it's time to buy. I mean, unless there's a fundamental reason why you shouldn't. If it's just getting hammered like this, great time to buy. Good company to get. Yeah, you're not going to get a whole lot of gains long term. Maybe you want to hold it for the dividend. The dividend's okay. Not as good as some of the REITs that I have, which is why I'd rather be in REITs instead of something like this for a dividend. However, it is a stable business. You can go to it. I actually went to Wendy's within the past week or so, and they're doing fine. And at least the one that I went to looked like it was doing pretty well. Not to mention their financials are fine. Everything looks good. So this pump all the way back up to 21 was expected, and it's exactly what I said was probably going to happen. The surprise was it did it while everybody else was down. So that, to me, that's a very bullish sign for this company. It makes me feel more secure the next time there's a chance to get in. If it drops really low or goes up really high, that's a chance to get in on that for me and watch it return to its mean. It doesn't mean it's going to stay in the 20 range forever, but because of the history of it and how many shares it has, it's going to take some effort to push it a little higher. And I think over time it will go higher because of inflation, because of the market, because of everything, blah, blah, blah. You've heard it before. But I do think this company is a great opportunity when it's way out. Like during the pandemic, great opportunity. When it pumped that one day, great opportunity. When it was down here in May, great opportunity. So I wanted to bring that to people's attention, that this stock is a good one to watch if it moves out of its natural range. I mean, it's one of the most stable stocks you'll ever find. That's why some stocks are only stable to one side of the equation. So the fact that, yeah, this isn't going to get any more gains, but it is stable. So if it's really high, it's probably going to get pushed back down. And this low drop, or this bounce, tells me that if it's really low, it's going to get pushed back up. So I like this one for a trade when it starts doing stuff like this. So that was another good one. I didn't do anything on it recently, but I noticed it was back up to where it was, so I wanted to mention that. The last couple of stocks I wanted to talk about, let's see, LYFT. They had some nice earnings. I know some of this happened like 2 weeks ago, but I'm doing streams every 2 weeks, so LYFT had a nice earnings report, and you can see with the chart, people were bearish on it because the last earnings report wasn't very good, but Uber did well, so people expected them to do well, and they pumped right after. They actually did well. They had, let's see, their EPS came in at negative $1.08, but the estimates were negative 57 cents. It's like, oh no, they were worse than expected. Why did they pump? Well, the revenue came in a little higher. They came in at 990 million. The estimates were at like 987. So a little bit higher on that. Active riders went up 19.9 million. It's up 15, almost 16%. So that is extremely bullish. The revenue per active rider is up 11% to $49. So basically $49.89. So basically $50 a rider. That's how much they're making. Because not everybody pays that much. Some people just get a quick ride, but you average everything together. $50 a rider is not bad, and that's up from what it was before. Also, they have 1.8 billion in cash and cash equivalents. So if there's a problem, they have enough cash to deal with it right away, which is nice. They didn't give Q3 guidance though. So I think if they had guided up, this rally would have been even stronger. And you can see it kind of hit a wall. And I think the reason it hit a wall was because they didn't give guidance. They might have gotten some analyst upgrades. I don't remember. I don't have that written down on my chart. But usually after a good quarter, some analyst is going to upgrade you. That's just kind of how it goes. But because they didn't provide guidance and there are still a lot of headwinds, it kind of hit this wall and it's not going above it. But this earnings report allowed a level change. So remember I was talking, well, the microphone was off. I forgot about that. So a level change to me is when a stock moves somewhere and then it can't go below it or above it. It's trading down here at this range, this level, down here at the tens, teens. Then it moves up, and now when it gets down, it can't go below the 1918 level. So it's hanging up around $20. It went from hanging around 15 to hanging around 20. To me, that is a level change, and there's support here. VWAP has come up. It's above VWAP. When it goes down, it gets rejected and goes back up. So that was positive for LYFT. But no guidance, so it's not continuing without more positivity in the market in general. We also had CURLF in the cannabis sector, the sector that has absolutely destroyed me. I've been doing so well on all these other trades this year. It's probably my best year for trading ever. However, cannabis is crushing me. So it's taken away a lot of the gains that I have just because cannabis has been so crappy. But with CURLF, they were forced to remove some of their cannabis units from New York stores because they used dry weight to look at the THC percentage as opposed to wet weight, which is normally what they do. But dry weight is a little bit higher percent accuracy, but the wet weight is New York's law. And the reason they went with dry weight, well, number one, because it's more accurate, but number two, it gives you a higher THC rating. So when people go into the stores and they see like, oh, this one brand has way more THC than all these other ones, well, it may not. It might be just because they did the dry weight instead of the wet weight, meaning if there's less moisture in it, each individual nugget is going to weigh less. So you can put more in there. You can pack more THC into the same volume or into the same amount of weight. So dry weight looks like it's a lot heavier potency than it actually is compared to the wet weight. So they had to take them off the shelves. That wasn't very good for them, but they didn't go down too much. See, that's the thing I'm noticing about cannabis. It's starting to pump up a little bit, and most of that is because of the market. Really, it's not because of anything bullish happening in cannabis. It's just because the market is allowing for things to go up again. But when it does go down, it sort of bottoms. If things continue to go down in the market, it'll probably go lower. But I like this as a place to buy because it's got a lot of support there. It seems to be hitting this low. I mean, look at this. This company had to remove a bunch of their product. That's extremely bearish. It didn't really go down that much. And that happened within the past week or so. I think this was the day. This was probably the day that it happened, I would imagine, with all this volatility. But because the cannabis sector is pumping in general, it got rejected. But that was kind of an interesting story. So keeping an eye out for the cannabis market. Things are really difficult. The thing we want with the cannabis market is legalization. My thought is at some point legalization is going to come in. I think it's going to take a while. I don't think it's going to be easy because politicians always have to add stupid stuff into every bill they put out. They have to get their cronies paid for whatever it is they're trying to do. And that holds up the bill because some other congressperson's like, no, I don't want that in there. And they're right. It's like, well, no, we should be doing this for the people. We shouldn't be doing this as kickbacks for whoever got you into office. But that's just how things work. So it's really difficult to get any bill passed. Not to mention there are people that don't want cannabis passed because it's going to cut into their industry big time. Timber, drug companies, everything. But the problem is those companies could use it. They don't have to fight it. That's the thing that I think they're eventually going to realize. Instead of fighting this thing and trying to make it, or trying to demonize it, trying to make it something that people don't use because it's a competitor, it's a successful competitor to your business. It may even be better, which I think it probably is in a lot of cases. Just use it. Go with it. Adapt to the times. You don't have to keep fighting it and holding back progress of the species because of some prejudice or because you want to make some money. Use that greed for good and say, all right, it's doing well. Why don't I make money off the sector? If it's better than what I'm doing, if I can get 4 times the output for the same amount of crops, why don't I just do that instead of spending all this money and time fighting it? It doesn't make any sense. But that's what happens. You're established, you've been there, and if you're older, you got the propaganda from the reefer madness generation. People think terrible things about it. But cannabis isn't just something that people smoke for fun. It's got so many industrial uses. It's got medicinal uses. It does have recreational use. It's easy to grow. People have been working on it for years. They can make it very potent. You can test it. How much THC is in it, how much CBD, etc. So there's so much more we know about it than we did before, and we're realizing that it's a very useful item. So I think one day people will realize, hey, we can make money off of this. We can make more money off of this than something else. So I think simple greed is what is going to save the cannabis market at some point. We just need to get the reefer madness types out, and they'll eventually go, because most people that believe that stuff are older. Although there are people of every generation don't like it, and there are some people that tried it and don't like it because they had a bad experience. But overall, most of it is just misinformation and refusal to actually look at the situation. And that's why I like the sector, because if you want to get in on something and make money, you have to get in on a sector that's beat up. Well, what's more beat up than cannabis, right? Maybe cryptocurrency, but I disagree. I think cannabis is the absolute worst sector. I think it's been beat up the most. It's not legal. It's not going to go up heavily unless it is legal, and that's what we're waiting for. Is it going to happen this time? I highly doubt it. But there still could be hype. My guess is that there's going to be hype in the marijuana space until we get a vote on this bill. So the CAOA, Cannabis Administration and Opportunity Act. It's unlikely to pass, which is the one that you see in the news, but the Safe Banking Act, HR 1996, seeks to prohibit federal regulators from taking punitive measures against lenders loaning to legal cannabis businesses. So that's the problem with cannabis right now. You cannot get a loan in the United States if you run a cannabis business. cannabis. You have to go through all these hoops and get investors in other ways, which is what they're doing. Or you have to operate in another country. So let's go to the YOLO real quick. Look at how low this is. This is in the 5s. My average on this thing is like 12. All right. I was buying in way too early. Cannabis is easily my biggest holding. And I've been buying in through all of, actually, I think I sold somewhere around here. No, I sold up here. Somewhere around 18, 19. Because I'd been buying it at 10 or lower for the longest time. It had this huge peak. I didn't sell at 30. I held. When it was down at like 18 or 19, I thought, all right, I need to take some gains. And I did. But I started buying in like 14, 15. I waited a little bit. I saw this pump and I was like, oh no, I'm going to miss it. On the way back down, I grabbed some and I've just been adding ever since. So my average is way above this. I'm extremely underwater on this, but I'm okay because most of it is in shares, and shares are good because you have all the time in the world. Over time, inflation and the usefulness of cannabis should push that thing up. At least that's my theory. I don't know if I'm going to be right about that. Cannabis could be dead for years, and it's dead unless we get legalization or something else that pumps it. Sometimes something will happen like in Canada where recreational use is federally legal, and that'll pump the markets in the US and Canada. So you can get in on stuff like these pumps right here were because of legalization in cannabis. So this is a newer ETF. It's not showing you that much more data. So let me go to the MJ, which does include some tobacco, but you can get a point. So here you go. So this was when cannabis was being legalized in Canada. So it didn't affect anything in the United States, but people were like, hey, recreational federal use in Canada. That means there's going to be a lot more profit. The potential for companies to get loans, the potential for companies to make more money because people will be arrested for buying your product. That was extremely bullish. But what happened when it actually became legal? When the vote went through and it went live? Boom, a drop. This pump was because the market pumped in general. Some of this drop was because the market was dropping in general, yes. But most of it was because all the steam ran out of it when everything was legal. So there's a saying, buy the rumor, sell the news, or buy the rumor, sell the fact. Whatever you want to say. That's basically been the strategy in cannabis the whole time, because it's not legal federally. Until it is, that will continue to be the strategy. So for me, my strategy is buy and get hurt. That's like, just be ready to get hurt. Like, I'm okay. I'm ready to lose money. I know it's going to happen. I have to be okay with it. Every time I buy, I know that a few days later, a few weeks later, I'm going to be down even more. And a lot of people can't handle that. A lot of people get in and they just don't know how to deal with their investments going down. Well, that's because you thought you were going to buy one thing and get rich. You put way too much money in it. You don't have experience in the market, so you don't see how things move day to day. It's very difficult to actually maneuver when you don't know those things. With me, I know those things are going to happen and I'm ready for them. I'm okay with that. I'm not dumping everything into cannabis, but I do know when it goes because it is so low. This is the kind of thing that allows you to make a good amount of money. Everything else I like is up. Amazon's great. I like Amazon. Apple's great. I like Apple. AMD is great. They're all up really high. It's hard to make a whole bunch of money on them because they're getting more and more expensive, so I can buy less and less of it. And the more it moves, the more resistance it gets. But here, we have so much upside potential because everybody's dumping. And when the hype comes back, they're going to come all back in. And that's what I want. This is a very volatile sector. Other things, yes, there are opportunities, but cannabis, I see a huge, huge opportunity. So I've been buying in the ETFs. I have some leaps in canopy growth. I had some grow generation, but it actually pumped a little bit, so I unloaded it the other day. Kind of wishing I hadn't done that, but hey, I made a little gain on it, so I'm going to be okay with that. And if we get another dip, I'm going to buy some back because grow generation supplies some of the, like the lights and the fixtures and things like that for these indoor growing operations. So it's like you get the cannabis and you get the supplies for the cannabis. To me, that's not a bad little move there. So I made some good money on, or not good money. I made okay money on it. And I wanted to take my gains and I wanted to use that money for something I think is a little better. So I did what I did. I'm very heavily invested in cannabis in general. So if it pumps, I'm okay. It's not like I'm missing that much for getting rid of one company. Now, if that company skyrockets, I'll be pissed. Yes. But making a little bit on it and then using it to maybe up my shares in something else, I like that too. So cannabis was looking really good. We had the CURLF situation. The bill's going in right now. It's going to be probably rejected, but hopefully there can be enough hype to get some kind of profit. Because my plan was buy in during the year as things are going down. And then as it gets closer to the election cycle, start getting ready to sell when the hype comes in. And make sure I'm out of almost all of it by the time the vote actually happens. Because whether it happens or not, it's probably going to go down. just because of the whole buy the rumor, sell the fact thing. So cannabis has been something I'm looking at. So let's see what's, Pinterest. Elliott Management took a stake in Pinterest and it popped. So Snapchat and Pinterest have been two stocks that I've been watching for a while. Snapchat's been a good moneymaker for me. It's extremely volatile. I was able to catch these big gaps a couple of times. And that's what I really like about it. Now, of course, this last earnings report, it didn't do so well for me. Oh, this is Pinterest. I was like, wait a minute, Snapchat didn't do this. No, Pinterest, Elliott Management took a stake in it. They're an activist investment firm, and they've got a pretty good track record recently with companies they've been buying into. So just because they took a stake, traders decided that they wanted to take a stake too, which is very common. If you see billionaires or giant hedge funds or people with knowledge and money making moves publicly, a lot of traders will follow that, which will kind of make it a self-fulfilling prophecy. But it didn't continue to go up. It popped and then it stopped because there are still problems with Pinterest. If Elliott Management takes a bigger stake or buys them out completely or whatever, then yeah, it's going to go up. But there's still other concerns. They're keeping the stock from going up any higher. I'm watching it, but I'm not doing anything on it, so it's not really that important to me. I did want to mention it because that's what happens. Sometimes you'll see a company reveal that they've had a stake in it for a while. It's not even that they just bought it. I mean, you have to tell the public with a certain amount of time, which is the whole Elon Musk thing. You know, he bought into Twitter and didn't report it until after the period had expired, which is why he's probably going to have some kind of penalty for that. I mean, there's still the whole rest of the drama going on, but you have to disclose a large amount of shares to people within a timely fashion so that investors can make moves based on that, and investors are protected from huge insider selling or buying that they miss out on or whatever it is. Just out of curiosity, let's take a look at Snapchat real quick and see where it is. I've been kind of letting it do its thing for a while. I actually bought another leap or two in it within the past couple of weeks, which is nice because they're up. I mean, I was buying leaps after this drop, which I got crushed on, by the way. So this earnings report, I bet not very heavily, but decently heavily towards the upside, and boom, got crushed. So that wasn't great, a bad trade. However, I was buying leaps in this mess down here. I didn't let this deter me. A lot of people would see this. They'd see that huge loss and go, oh, I don't want to do this anymore. Well, to me, that was like, okay, that was a nice little level change, right? It was hanging out in this level. Boom. Now it's hanging out on this level. And this is a great place to buy. So I was buying in here, and now all those contracts are up because the market's been pumping in general. But look at where the top is. Somewhere around where it opens. A little bit above, yes, but this is a point that there's going to be some resistance because this is where it gapped down to. So this is kind of an area of high resistance until it gets back up to here, which is an even higher resistance area. So this has some work to do before it can go again. But my thought is I'm waiting for earnings season. This is a big mover on earnings. If you look at where these giant moves that happened in Snapchat, you can see big move right here, earnings. Big move right here, earnings. Big move right here. There's a gap up, earnings. Gap down, earnings. Gap down, earnings. I mean, this is insane, right? The gap down earnings for the one we just saw. All these gaps, lots of money to be made, mostly on earnings. This was the famous one for me. This one I called. I actually got out of my contracts a little early. I remember I had calls and I was up a little bit because I was buying in right here somewhere in this mess. So right before the earnings were released, I was up and I thought, oh man, I either take this gain that I have now or risk losing it all. Well, I should have held because the thing went insane. I think I actually did have one contract, so I did catch a little bit of it. But this move right here taught me that like this line represented where it IPO'd. This was a big point of resistance, and it took years to get to this point. So passing this point was a big deal. It was extremely bullish for the stock, which is why it kept going. And at the time, their growth was insane. Snapchat growth was going nuts at this time. It's not anymore. TikTok has been cutting into everybody's user base heavily. TikTok is still growing, and it's growing at a really fast rate. So it's actually a decent competitor to all the social media platforms now. Do I think that's going to go on forever? No. I mean, it's just kind of the popular thing right now. You think about MySpace was the popular thing for a few years, and then it was usurped by Facebook, which was the popular thing for a few years. And now we kind of have like the postmodernism version of social media now. You know, Instagram, Snapchat, Twitter, all these different companies, TikTok. This is where social media has gone. And the model of the previous social media generations is changing because everything is more useful now. TikTok is extremely useful. It's easy to use. It's short. It's quick. Your attention span is completely ruined by it. but it works for you. I mean, if you get on TikTok, you can just scroll, right? People like that. Snapchat has these rules. It's like you take a picture, it's gone in 10 minutes, but you can use Snapchat to call people if you don't have a phone. There's premium Snapchat, so you can have a business and you can charge people for your services using that. I mean, there is a lot of utility in Snapchat itself, but a lot of places are doing that. You can do the same thing on Facebook. You can do the same thing on Instagram. You can do the same thing on any social media platform now. It's just how it all runs because they found that was the thing that people wanted. That was the most useful thing. So Snapchat does not have the same bravado that it had before all this stuff was going on. Because look, it's been in this downtrend since the late last year. So this didn't happen just with the market. This was already going when the bear market started. It's been falling out of favor for almost a year, actually. So when was this drop? So this was October, and we're in mid-August right now. So yeah, it's been dropping for almost a year. I mean, I like that as far as a pump. And if you look at where it bounced, it was the IPO price. This line that I put in, it was a heavy support for a while before it finally broke through it. And you notice, let me zoom in a little bit just so you can get a lesson on this kind of stuff. You notice when you see real support and resistance, like you could put lines anywhere, like, oh, there's one here, there's one here, there's one here. Yeah, I know. But really big support and resistance points are the ones you should look at. Because look at what happened. Bounce. When it cut through, it got highly rejected, right? It dropped on earnings and then it popped. But that squeeze was short-lived, and look where it came down to. The big resistance mark right at its IPO price. Went below it, popped again. And then when it went below it, when it was confirmed that it was going below it, it took a little time to get beyond that point. It had to come back up and test it. See, like it broke through, came up and tested, got rejected multiple times, and then it dropped. This was a very important point, which is why I think at some point in the future, this stock could get back up to this point and break above it like it did before. It moves a lot. It is a huge mover, one of the biggest ones on the market, which is why I'm always watching it. It had its earnings. It's done for a while, but I'm looking at the future. I mean, with so much down movement, it's got a surprise to the upside hidden in it somewhere. When that upside surprise is going to happen, I don't know, which is why I bought long-term contracts. I think it's going to happen before 2024. My gut feeling says it's probably going to happen sometime this year or early next year. At some point, the market's going to get over all this messiness and continue on its path. That's what the market does. It has messiness for a while, maybe a few months, maybe a few years, but then it continues on its upward path because that's the trajectory of a system that's built the way this is built. It is built to continuously rise. This whole 2% inflation thing is because if you do that, you can continue a system of unnatural growth for longer. But we're in a point where Snapchat has an opportunity for the future. Now, I don't know if it's going to happen right now, which is why it's not good to just go rush in and buy everything, but slowly picking stuff up. That's the name of the game for me. Pick up things slowly when they're getting murdered, which Snapchat is getting murdered right now. All right, so let me see. What do I have? Anything else to talk about? Oh, Robinhood. That was the last one before we move on. Now, Robinhood has been an interesting stock as well. I bought into this. I got crushed. I mean, I was buying through this whole mess. I think I started somewhere around 20. So where was I? Yeah, so I let it go down a little bit, but I remember thinking towards the end of the year, like, ooh, this has dropped way below the IPO price. It's been trending down for a while. It's below the standard deviation mean. It might be worth looking into. So I was buying, just getting crushed. Then we had this spike right here. It brought it back up to the let's see, 16 or so. Yeah, my average was around 16. So my average started at about 20. So I was buying in at like around 20, maybe a little bit higher. And I was slowly bringing that average down to about 16. But it was 16 when the stock was down at like 10. Right. So for a while, I was underwater for quite a while. I thought, this earnings report pumped it a little bit, but not enough to give me what I needed. This little thing right here pumped it up to 16, which was a hair above my average. I was like in the low 16s and it pumped to the high 16s or something. So I thought, all right, this is a time to get rid of as many shares as I possibly can. So I did. I unloaded like 95% of my shares right in here. And I'm so glad I did. Right. I still had a good amount by the time it was dropping down into the sixes, but as it pumped after this last earnings report back up to 10, I sold some more. So actually, I think I sold it all. I don't know if I have any. I might have like 5 shares of it or something stupid like that, if I have anything at all. I got rid of everything. And now, of course, look at it. It's starting to pump a little bit, and it probably will ride the market. But the thing I don't like about it is it makes most of its money for payment for order flow, which is under scrutiny right now from regulators. Are they going to get rid of it? Are they going to change it? I have no idea. If they don't get rid of it, Robinhood will fly. Robinhood is set to explode if something like that happens because the tension is what's keeping this thing down because they make good money off of payment for order flow. But right now, what they're trying to do is they're trying to make it a little bit more transparent because Robinhood's just in bed with their buddies at Citadel and whoever, and that's who they give their orders to. They kind of have their own little network, their own little clique. They send the orders to them, and those people make as much money as they can off of it. If the SEC has their way, then they're going to have to be more transparent and show you what those trades are. If someone's making a massive profit off of something that they shouldn't be making profit on, well, then we'll be able to see it. They also want to increase competition between other entities. So Robinhood would have to send it into a pool of people, and anybody in that pool could get it. It wouldn't just be their buddies. So that's the other thing that wouldn't be as profitable. Like, the reason Robinhood is making so much money is because Citadel continuously pays them to send them their order flow. If that revenue stream is disrupted, Robinhood is hurt. So they're trying all these other things. They're having varying levels of success. They have like a checking account, kind of. They have some sort of a savings sort of thing built into your cash feature so that you can earn interest on the cash that's just sitting there. They have a crypto wallet now. Like, they're doing all these things. They're making improvements. I actually like Robinhood. I think they're a decent company. But in the back of my mind, I also think they're a little bit shady. To be totally honest with you, I use Robinhood. Robinhood is what got me into trading. Or I shouldn't say it's not what got me into trading. It's what allowed me to trade. So I'm grateful for that. And I understand the utility of Robinhood and their app. But that doesn't mean I don't think the people that own it are slimy a little bit. Like, they're a little bit sleazy. They see, like, just watch the interviews with them, man. They look like car salesmen. They're not really media people. They just look like they set up because they're investment bankers or something like that decided to make an app to get trading into the hands of people who weren't able to do it before. It was a good way to make money, and it was a really good idea, but that could come to an end if the SEC crushes their ability to sell payment for order flow. Until that is settled, I don't really want to own the stock because it could continue to go lower. But at the same time, if it's settled positively, it could explode. So I don't want to miss it. My thought is, I think I'm going to start buying leaps in Robinhood on downward moves, just because it's a way better risk to reward ratio for me. To get the shares and make a bunch of money, I have to buy a lot of shares. I have to put a good amount of money into that thing in order to get the return that I want. With options, I can use significantly less money, but I'm timed. So if I get the 2024s, I have a little bit of time, but if Robinhood doesn't do anything, those contracts will just expire worthless, like a lot of them will. It's something I'm watching. It's something I actually like, but it's also something I'm not naive enough to ignore the negatives of. Right? Because it has a lot of negatives. So that was an interesting story. They did well on earnings. That was what I'm going to say. Yeah. So their EPS came in at 34 cents. The estimates were 36. So they lost less money than expected. The revenue that came in was 318 million. The estimates were 313. So they beat those expectations too. That's bullish. They cut 2% of their staff. That's bullish. More money to do stuff. They got analyst upgrades. That's bullish. The crypto unit was fined over $30 million for anti-money laundering failures. Also, the SEC is probing Robinhood over short selling and fractional share rules compliance. And that's another reason why I didn't want to hold the shares, because they have a lot of legal trouble that they have to deal with right now. There are multiple incidents that they have to deal with that are costing them money. Like the crypto wallet thing is one. The fractional share thing is one, because the thing about fractional shares is you have to report that as a full share in the trading volume. So if you buy a tenth of Amazon in the trading volume, that looks like you bought one full Amazon. So the volume gauge is actually not accurate anymore. It's close, but because all these companies are offering fractional shares, it's throwing the volume off. I think at some point they're going to change the regulations and the volume problem will be fixed. But right now, volume looks like it's higher than it is because fractional share rules say you have to report it as a full share. So if somebody buys a tenth of Amazon 8 different times, that's 8 shares of Amazon when they haven't even bought one. So you see how the volume can get really weird over time with this fractional share thing. So Robinhood had some problem with that, and the SEC is looking into that as well, and that could cost them. But the other good thing that was happening is their monthly active users went up 14 million. So that's a 1.9 million year-over-year increase. Oh, no, I'm sorry, decrease. So it's decreasing a little bit more than it did last year, which makes sense because last year was the bull market. Everybody was into it. They all wanted to get in. Now that times are hard, everybody wants to get out. So companies like Robinhood that are catering to those type of people, they're going to be hit harder in these downturns, which is what is happening right now. But the earnings weren't too bad. So yeah, their money stream is in jeopardy. They have a lot of legal trouble. That's why I don't know if they're going to move too much right now. That stuff has to get solved. But they have some bullish aspects to them too. Like they made a little bit more money than expected. They took in a little bit more revenue. They got some analyst upgrades. Let's see, their options and stock revenue is down. It's down. The crypto revenue is down. They have $64.2 billion worth of assets under custody, which is up a little bit. Their operating expenses are up 22% year over year, so it's costing them a little more too. That's no surprise. It's happening to a lot of people. Their average revenue per user is up to $56 from $53, so that's good. That's another bullish sign. And there's rumors of it being acquired by FTX or Charles Schwab. Now, they denied it. Vlad Tenev, one of the CEOs, he denied it on the conference call, but that's a rumor. That could happen. If Robinhood gets gobbled up by some other company, that is extremely bullish. And honestly, Robinhood would be a wonderful target. If anybody wanted to get into any of these spaces like the crypto space, which is difficult to get into with regulations the way they are, buying Robinhood would be a great way to do it because they're already set up. Yeah, they don't have every cryptocurrency in the world, but they have a lot of the popular ones, and that's all you really need if you want to make money. Also, the good thing about having a minimal amount of currencies is it's less likely that they're going to have a scammy currency on there. There are a lot of scam altcoins out there, and you have to watch out for that. But with Robinhood being so picky with what they're putting in there, it's good protection against that. So they might be bought up by somebody, even though they were denied. I don't think it's going to happen right now. There's still that possibility. So that's the other reason why I want to get leaps in Robinhood, because if they get bought up, those leaps are going to go to the moon. So the other problem is, though, if they lose all their revenue stream and they can't figure out a way to do anything, then they're going to become a penny stock. So they're basically riding on the border of, are they going to be a penny stock or are they going to be a real company? They're in limbo right now, and it's very hard to judge that. I do think it's more likely that they will be a legitimate company than not, but it's such a close call that I just don't feel comfortable investing a whole lot in there. Putting a little bit, like a few $100s into some leaps, yes, I'll do that. That sounds good because I would like to capitalize on that, but I want to lower my risk because there's a good chance that they could become a penny stock. So that was all the information about stocks. Oh, that was the other thing. The Inflation Reduction Act passed 51-50, so barely. It pared back some of the elements of the 15% corporate minimum tax, and it added a one. Here's the thing. Okay, this is why I want to talk about this. So this is what hurts for me. The Inflation Reduction Act came in. It's going to raise taxes to take care of a lot of some of this stuff. We all knew that. That's just kind of what happens in times like this. But the thing that was really big that they had to adjust was the 15% minimum corporate tax. That was a tough one to get by because there are certain corporations that don't pay anything or pay next to nothing in taxes because of tax loopholes that I'm sure they lobbied for, or companies like them in the past lobbied for. However, with so many powerful people being possibly hurt by that, they kind of amended it a little bit to make it softer. So it's not as hard of a tax as it was before. There are ways to get around some of it now. But the thing that I don't like about it is the fact that they added a 1% excise tax on share buybacks. All right, so share buybacks are extremely bullish for the market. Now, politically, they're kind of a contentious issue because you think about what can a company do with money they get? They have a couple of options. One, invest in the company. Two, hire more people. Well, I guess that would be invest in the company, basically. So when I say invest in the company, I'm talking about hire more people, but also research and development, improving their stores, improving their supply chain, whatever it is. So you can take money and you can invest it in that to make your business better. Or you can take the money and buy stock with it to make your stock price go up, which is what a lot of companies do. They'll get money for some reason, and then they'll buy back a bunch of stock instead of hiring people, instead of improving the equipment, instead of adding research and development pay. They just add more stock. So that can be abuse, and that's why politicians don't like it. They want it. It's a very big talking point. Stock buybacks are evil. Stock buybacks are evil. I disagree. I don't think stock buybacks are evil. I think companies should buy back their own stock if they're bullish on their own business. If they're confident in what they do, they can buy back some of their stock, increase the price for people that believe in them as well, and just make it better over time. However, I think they need to balance that with the health of the company and the security and health of the workers. A business comes down to having good workers. If you're really skimping on who you're hiring, those results are eventually going to show up in the end product. There's no avoiding terrible workers, right? But if you get good quality workers and you pay them the way they should be paid, your products will come out the way they're supposed to come out. Things will run better. So it's good to invest in the business. However, you need to have a balance of that, because you can only put so much in there. If at a certain point, adding more employees or paying employees more doesn't give as much of a return as it does in other areas. But when things are really running well and everybody's paid well, it doesn't make sense to keep adding money into something that's working well. That's when you'd want to go into the share buybacks to increase the price for everybody else. It's not just people that are trading stocks, it's half of the country. A good chunk of the world own stocks in their 401ks, in their IRAs, whatever it is. The market is helping them retire. And adding money to any stock that's in those indexes or in those portfolios helps everybody. It helps your grandparents, it helps your parents, it helps you, it helps your children. It's a way to secure your money for the future. So I don't think stock buybacks are evil. I think they can be very helpful, especially if more people are invested, because I think just a little over half of the country is invested, but I think that number should be higher. The problem is a lot of people don't have the money to do that. A lot of people don't have extra money to just shove into the markets. People do need help. We do need to make changes to the economy and make it so people can excel and get out of the situations they're in. And I think one way to do that is to get more people invested, get more people into, instead of buying rims for your car, buy some good stock. Like there was a point in my life where I realized money is not what I thought it was. As I was growing up, I always thought, okay, money is just something you exchange for goods and services that you want. Money is just a means to an end. It's nothing more. It's evil because it makes people do bad things, but it's a necessity because we have to use it to run our lives. And then at one point I realized there are other ways you can look at money. You can take money, you can buy something you like and get joy out of it for a little bit, but then that money is gone and the joy is finished. So you basically threw that money away. Maybe not, you can have a good experience. I'm not saying never buy anything, but you have a choice. You either take that dollar, you buy something with that dollar, you use it, and then the dollar and the thing are gone. Or you take that dollar and you put it into something that makes you money over time. So that dollar isn't gone, it's growing. And you do that with more dollars. And more dollars and more and more and more until eventually compound interest actually makes your wealth grow in a way you never thought possible. See, this is why I like dividend stocks, because it's a very slow climb when you're first getting into dividend stocks. You're going to buy a little at a time. You're not going to have enough to retire on your stocks right away. But if you're putting a little bit in over time, eventually that adds up, and compound interest makes it grow faster. Think about cell division, right? You have a cell, it divides into two, and then both of those cells can divide into four. So the more cells there are, the more divisions you could have at each occurrence. Basically, the bigger you are, the faster you grow. And that's the same way with your money. If you have compound interest constantly buying you shares every quarter, then you're going to get a little more because now you're getting what you had plus one more share's worth. Right? So if you're getting 20 cents a share or something like that, another share gets you another 20 cents. And that's 20 cents you're going to get every quarter for the rest of your life. But you think about that one share is going to grow because you're going to get another share and another share and another share. And eventually the money will be enough to where you can buy 2 shares at a time. So you're going to get 2 and 2 and 2. Then you're going to get 3 and 3 and 4 and 4. And eventually you could buy more and more each time. And instead of buying 1 more share each time, you buy 20, you buy 100, you buy 1,000 more each time. And it just gets so massive later in life that it's worth doing. It's something you can't see now. Concepts that are in the future are difficult for people to grasp because they can't see the results right now. It's why a lot of political battles happen, because we talk about things that haven't happened yet, and we're saying it's going to be this or it's going to be that. No, you don't know. So you're looking at the now, you're thinking, if I buy a few shares of some dividend stock, I'm going to get a few dollars every 3 months. That doesn't help me. Well, yeah, of course it doesn't. You're going to get a few shares every 3 months and you'll be able to buy like a candy bar with it. Yeah, I know that doesn't feel that good. And it seems like I should be making more, but that's not what you're doing. You're going for the long game. You're trying to get money over time. You're trying to make money to retire on. That's what happens with compound interest. I think it was Albert Einstein that said something like, most people don't understand the power of compound interest or something like that. I don't know. There's a quote out there. Somebody could find it, but it's true. I mean, over time, you're getting more and more and more. The more you have, the more you can make. So when you are retiring, hopefully your dividend stocks are paying you out huge and still growing like mad because you have more potential to grow each quarter. So that's what I like about these stocks. I want to have a mixture of things. I want to have some dividend stocks to think about the future. I want to have some growth stocks to try to make money in the short term. I want to have a hedge in case things go wrong. And I want to have some cash. So number one, I can earn interest on it. And number two, I can make moves later if I need to. Or if there's a problem in my life, I have a little cash saved up so I'm protected. So it's like, that's what I think some of the best positions are. Have something for the future, have something for the now, have a hedge, have some cash. That's kind of a simple way to put it, but that's kind of the summary of my portfolios. Actually, if you mix them all together, that's what they are. I've got my trading portfolios, I've got my long portfolios, I've got things mostly in the upward direction, a little bit of protection to the downside. I've got some cryptocurrency as a speculation, so get some growth, some speculation, some dividend stocks, hedge, cash. Boom, there you go. There's your portfolio right there. Woo! Okay, I'm getting a little too excited because we're getting down to the end of this thing. So it's been an important week. I didn't talk about half the stuff that was on my list, but I'm going to have to get going here. I haven't checked comments in 1,000 years. Wendy's trended up because they have hot fries. Exactly. And then let's see, Coinbase to the moon. It's possible. Coinbase is in a really good spot. So that was one thing it's on my list and I didn't talk about it. I like Coinbase as a prospect. I do think it's going to be tough for them because they still have the headwinds that they've had the whole time. But they're in a situation to where when crypto pumps again, they're going to look really good. They just got a contract with BlackRock to help institutional buyers purchase Bitcoin, i.e. really big money firms are going to be buying Bitcoin through BlackRock, and those transactions are going to happen because of Coinbase. My guess is they're going to take a cut. BlackRock and Coinbase are going to have to profit off of this because it's a deal that's mutually beneficial. So BlackRock is literally the biggest asset management firm in the world. It is massive. It has trillions of dollars under management. So Coinbase being able to partner up with them is such a good move. That is extremely bullish for Coinbase. However, they still have the headwinds of the market. They've had some downgrades because people think, all right, with the crypto market down, with users drying up, with the ability to borrow against smaller and smaller positions becoming a reality, Coinbase has some headwinds to get over. But in the long run, I think they're going to be decent. I actually do like Coinbase. So thanks for bringing that one up. I actually did want to talk about that. I think I had it in my notes. S&P Global downgraded Coinbase's debt rating due to the crypto winter and weak earnings. So this is a temporary thing. That downgrade is going to hurt them in the short term, especially if we start getting a market downturn. But if the market continues to go up, Coinbase is going to go with it. Crypto is going to go with it. And the higher crypto goes, the better it is for Coinbase. So Coinbase has basically a 2x rise or fall because of the business they're in. They're in the stock world. They're in the world of fiat currency because they have to run everything, but they're also in the world of cryptocurrency. So if either of those markets pump, they benefit, which is what I really like. There are some other stocks, but Coinbase to me is because it's come down so low. Coinbase just got absolutely murdered. I mean, it IPO'd, right about 325 or so, 330, 320. It was an insanely high price. And that same day, it pumped up to 429, but it never got back. It went down. It kind of settled at this level. People were thinking, all right, it's okay. It's down a little bit, but not too bad. We can do the hundreds. We're down $100. No big deal. But it peaked. Again, it went up and it peaked, and it's just been dropping ever since. This last earnings report was what really killed them. And that, to me, that was a good opportunity. If you look at it, ever since that report, it kind of trended sideways for a little bit, but it's starting to head up. But look at this. If you're a technical analysis person, this is looking like either a bull or a bear flag. I mean, you could debate on which way it is. It's kind of heading down a little bit, so a lot of people would say, oh, it's going to explode to the upside. But to me, it's following the mean. I mean, look at the standard deviation channel. Yes, it's not a lot of data. I know. But look at where this is traveling. This downward trend after the pump is literally sitting on the mean for the entire stock. So this is a really, to me, this tells me it's going to move big in either direction. Because it's sitting at the mean, stocks rarely do that. Not to mention, we had the crush right here. Most people are out after that last earnings. People really were bearish on it. The crypto market is giving it a price floor too. That's the other thing. With crypto sitting at the same point, Bitcoin's been in this 18 to 24 range for a couple of months now, but it's sitting there. It's not going any lower. So you at least have that to borrow against. You at least have that to show hope for the future. The fact that it's not continuing to go and it's kind of forming a floor, to me, is extremely bullish. A lot of people are bearish on crypto and they don't think it's ever coming back. They think it's a scam. I disagree completely. Yes, it's going to suck for a while. I don't think it's going to be back right away, but I think crypto has, as long as there isn't a catalyst that destroys the entire sector, let me put that caveat on there, because it is extremely risky. Cryptocurrency is extremely risky. It's still an area that isn't as regulated, has huge volatile moves, and could go in any direction. Because it's low, and it wasn't going much lower than this, it's been bouncing off this 50 range for quite a while, and now it's sitting up and kind of level changed up into the 80s. As long as cryptocurrency doesn't continue to drop, Coinbase is going to have a nice price floor, assuming they don't have any more insider trading. And what hinges on that case is whether or not some of the tokens that person traded were securities. See, that's important because if these tokens are a security, they are tried under the rules of stocks. They have a different set of rules than things that aren't. And Coinbase is trying to say, no, we don't allow securities on our platform. Why? Because then that would be a whole other regulatory mess that they would have to deal with. And they don't want to do that. So they're saying, no, it's not a security. And the SEC is like, yes, it is. Why are they saying that? Because they want to prosecute it. People are so desperate to regulate crypto. It is such a threat to the entire monetary system. It's a threat to the structure of the world. And people don't realize that. But the ones in power do. And they want to cut this thing down. They want to basically find a way to protect themselves from this getting out of control, because this was supposed to be an alternative to the fiat money system. And it still is, even though it follows the market. It still is protection in some way because it's an alternative system that you can use if you can't use the fiat system. Think about Russia, right? They got cut off from SWIFT. They weren't able to process transactions. They're still not able to process transactions. So it's very difficult for them to use any kind of world currency that's within this power structure to buy things. Now, the countries that are sympathetic to them, they can still trade in those currencies. But think about cryptocurrency. If you're Russia and you're looking for a way to continue business and you need a lot of supplies and resources because you're fighting a stupid war, then you need a way to pay for things. And cryptocurrency would be a really wonderful way to do that for anybody, including them. So I think that in the future, we're going to find out that cryptocurrency was somewhat involved in this war, because you think like, how is Russia sustaining all this stuff? Yes, they're having problems. And yes, they had a good stockpile of things in general because they're a huge country, but they need outside goods and they're getting them somehow. So I would imagine they're using so many different tactics to get things that at one point we're going to say, oh, cryptocurrency was involved a little bit too. What do you know? So yeah, cryptocurrency is not looking good right now, but it's had this pump. In fact, let's go to the futures for Bitcoin/BTC. You can see that Bitcoin kind of came up. It's hit this 24 level, and that's about where it wants to stay. It doesn't want to go above that right now. But that makes sense. There's not a whole lot of news in the crypto sector that will move it, that will give it that level change, right? See, right here's a level change. I want to see another level change in crypto, but I don't think it's going to happen until we get a reason for it to happen. Now, this elation from the market relief has helped a little bit. I think that's actually what's driven it up from the low 20s to the mid 20s. But how long will that last? If the market continues to go back down, then crypto is going to suffer as well. So I'm still doing the slight buys. Like I'm buying a little bit of crypto, I'm buying a little bit of cannabis, and I'm buying the companies that I like. Now things are starting to go up. And if this is a rally that's permanent, because this rally could continue, the bears are going to bet against it. And how heavily they bet against it is going to decide how high this rally goes. We don't have a catalyst pushing us either way right now. So we're kind of using inertia from this entire explosion after the market's pressure was relieved. So it's just going to go until it hits something, right? It's like you throw an object in space. It's just going to go in that direction until it hits something. That's what the market's doing right now. We're waiting for a catalyst to knock it down or keep pushing it up. My guess is that a downward catalyst is going to happen because at some point it's got to hit something. It's got to hit resistance, stop, reevaluate, and then the pressures of the market are going to start to push it down. It's like you stub your toe or you hit your knee or something like that, and you don't really feel the effects of it until you've gone to sleep and you wake up the next morning like, oh, my toe's so sore. It's a delayed effect. It's there, but we're waiting for it. So did I have anything else in the cryptocurrency space? Let's see. Solana network was hacked. 10 million was taken. Multiple outages on this network recently. So Solana's having some troubles. I actually own a little bit of that. Not a lot, but a little bit on Robinhood. Let's see. Also, $2 billion has been stolen from crypto bridges in the past, or in at least 13 cross-chain bridge hacks. So I've been talking about this for a month or two now. These cross-chain bridges, they're a great way to get cryptocurrency in between blockchains, but they're also such a vulnerable target. They're getting hacked all the time. People are walking away with millions of dollars. It's adding supply to the market because these bridges don't destroy the currency when they move it to the other chain. They basically just lock it up. So you're adding inflation. You're adding coins that wouldn't normally be in there if someone hacks that and takes those coins, which is what's going on. These bridges have all this unused crypto that's just sitting there in limbo. Hackers are taking it and they're getting rich off of it. It's so hard to put security onto a bridge like that because the more you lock something down, the harder it's going to be for average people to get their tokens to other chains. And the point is to make it so average people who don't know much about this can use it as a currency. I mean, all these cryptocurrencies they do all kinds of things, but they're striving to actually be money in some way. And the only way you can do that is with stability, which cryptocurrency just doesn't have. It is a speculative asset and it will remain so until it's more secure and more stable. So listening to all these people that want to say crypto is going to change the world and do all this, it might, but you don't want to get too into that yet because it's got to get there first. The realities of things have to work themselves out. It's one thing to say all this stuff about your cyberpunk future. It's another thing to actually bring it into fruition. So we've got this pump. Not sure how it's going to last. I'm watching it. I think I'm in bull mode, so I think it's going to continue a little bit, but I want to see when it gets into this high resistance spot what it's going to do. Earnings are continuing, so I'm still watching. We're still in the heart of earnings season, but we're getting towards the end. We're starting to move towards the late stage of earnings season when the less important companies are reporting. Companies you don't know as much about. There's still a lot of important companies that need to go, so I'm going to be watching them, but we're getting to the stage where earnings season is starting to wind down. So keep that in mind. Earnings are still pumping things, but we've had a good chunk of it already happen. Let's see, the market reaction to one of the two most important economic reports. We still got more economic data to come out before the next Fed meeting, hopefully. That's the other thing that the market is waiting for. So we're going to watch that data. The first of the 2 points was positive. If the second of the 2 points is more positive than the previous set of economic numbers, then the market, I think, is going to have an extreme rally. And that will be interesting to see, because if the market does have an extreme rally, the Fed's reaction is going to change because they want to stamp that down until prices come down, which is going to take some time. It's not just going to happen right now. At the very least, it's going to take months, not days or weeks. So we got to watch that. Let's see. Fed reaction to the market. So that's the next thing. The market's going to react to the data, and then the Fed is going to react to the market. So basically what the Fed was trying to do, this kind of clicked to me the other day. The Fed wanted to crush the market and then cause a rally, right? They want to bring everything down as much as possible, and then they want it to jump to see how high it will jump. So this is a test for them. If they have a rally that's reasonable, doesn't go too high, has some capitulation, and continues the trend, then they'll know, okay, we're on the right path. But if they have a rally that goes all the way up to previous highs and goes past it, an unsustainable rally in a market that has pressure, then they know they're going to have to turn things up even more. So the amount of bullishness in the market will somewhat determine what the Fed's going to do the next time. So we're watching the economic numbers, we're watching the market's reaction to those numbers, and then we're watching the Fed's reaction to the market. So it's a chain of things. It's a little bit complicated, but they're wanting to see what this rally ends up being. And that's what I'm watching too. How high is this rally going to go? If it gets rejected or hits kind of a top and goes sideways for a while, that is a good thing. To me, that's the most bullish option. If it falls, that's somewhat bullish too, but it's also falling, so you have to be prepared for more downtrend if that continues. But if it goes way, way up, then I'm out. I don't want to be a part of that. Like, if the market really rallies, that's a chance to go heavy on a short and get out of some of your long positions, take your gains. Because if things go up to previous highs, if they go up to the all-time highs, I'm taking most of my contracts off the table, most of my long stuff. I mean, my long portfolio I'm going to leave, but all my trades, my 2024 contracts, the leaps, they're gone if it gets all the way up here. Because it could continue if it does that, yes, but it's so volatile and there's so much pressure. I don't want to be exposed to the upside heavily while things are going down. So you got to watch that. So last thing I want to say is, if anybody has, what charts are you watching? Because I want to know what other people are looking at. What are your opinions on the market? So that's what I want to know. Number one, what are you looking at? Number two, what do you think is going to happen? Do you think this rally right here is going to continue? Do you think it's going to go sideways? Do you think it's going to go down? Do you think there are any factors that might cause it to do any of those things? What is your opinion on the market? How do you feel about it? But for now, that's kind of what we're looking at. We've still got earnings. There's some companies coming up in the next couple of weeks. Yeah, Target's coming up on the 17th, so that's one I'm going to watch. After this last drop right here, Target is it's a target. I want to look at this one because it really, oh man, I could have made so much money on this and I didn't trade it. This just hurts my soul to look at this thing right here. But it came back up to where it dropped down to. This is something to look into. So I am definitely going to be watching Target. And if I'm watching Target, then I'm watching Walmart. And what do you know? Walmart reports first yet again. It's the exact same story as last time. Because Walmart, that's what happened. Walmart reported, tanked the market, tanked Target, and then Target reported and completely lost it. So we got something down here. Let's see. You're feeling bullish. Oh, Salome Fishby is feeling bullish overall. I agree with you. I think that's the kind of sentiment in the market right now. It's tentative bullishness. I don't think this is the rally. I don't think we're starting the next phase of bull market that keeps going up and brings everybody back in. But I do think this rally is going to go on for a little while. The question is, how long? So it looks like a lot of people are bullish. It's not just me. Consumer sentiment is up. If you look at those numbers, it's been climbing up every month. And when I talk to people, they're bullish on the market. So I think that's a good sign. I think people are going to be, as time goes on, they're going to get a little bit more bullish on the market, which is going to be a self-fulfilling prophecy. It's going to move the market up. There's a lot to talk about. I didn't get to all of it. There's just so much. It's hard to get everything in on one broadcast, especially since I just ramble and I go off and I have all these different points and then I forget about things I was going to say. Like it's, no matter how much I prep for this thing, it's still just, it's an absolute madhouse in my head when I'm trying to do this thing. So I'm going to get out of here. Thank you for joining me. I appreciate it. Hope everybody had a good weekend. Stay safe. This is an interesting time. The reason I was saying this was such an important broadcast is because we're waiting to see if this is going to be a real bull market or not. How long is it going to last? So trades to the upside, maybe looking at some stuff to the downside for the later, but we have to see what the market reacts to. That's what I was saying. This next week is important. If we finish this next week higher, then that's bullish for the coming weeks, for the next month or so. But if we don't, if we hit a top or we go down lower, that could be the start of another decline. I'm not saying either of those things are definite, but I'm saying there are high odds of those things happening, which is why this next week is an extremely important week. It's one of the most important weeks we've had yet. The Fed is going to be watching this stuff. A lot of the tension has been relieved from that Fed announcement. Now we have to see where the waters settle. So that's what I'm doing. All right, I'm going to get out of here. Thank you for joining me. It's been a really crazy week. It's probably going to continue to be crazy. Stay safe with your money. Be ready to trade. Be ready to hold. Whatever you got to do, just do it. All right, I'll see you later. Have a good weekend.